Very respected speakers of this evening, CA Bhavesh from Mumbai, CA Roopesh from Chennai, Secretary of SIRC, CA Panaraj, participants of this evening program. Very good evening to all of you. Friends, it gives me a great satisfaction to once again join with you all for this important program on recent developments in transfer pricing. Though it is a very limited applicability, everyone should understand the concept of transfer pricing and its applicability. So we have to attend this kind of program and enrich our knowledge on the subject. Today we have with us very good speakers sharing their knowledge and experience with the elite professional gathering through this virtual mode. On behalf of members of this region, I welcome CA Bhavesh and CA Roopesh to this virtual program. My sincere thanks to them for accepting our invitation and addressing us. I also welcome each one of the members who are participating this evening program. I am sure the exposure that the participants will get on the subject of presentation by the speakers of eminence and their expertise will broadly update our understanding on transfer pricing. Before into the technical topic, myself and secretary will share some of the basic informations about the speakers. CA Bhavesh is the fellow member of the Institute of Chartered Accountants of India and a Bachelor of Commerce, University of Mumbai. He is a partner in one of the big four audit firm in India. He is specialized in the field of international taxation and transfer pricing services. He has professional experience of over 16 years. He has worked on several transfer pricing and international tax assignments, including the corporate restructuring, having tax and regulatory implications in India and overseas. He has been involved in assisting multinational clients in reviewing documentation necessary under the Indian tax laws and an assignments involving verification and certification of compliance with the various procedural and filing formalities under the income tax laws. He has advised clients on framing transfer pricing policies, business models, intra-group arrangements, and global transfer pricing documentation for large corporates. He has handled several landmark and high-stake transfer pricing litigation matters for clients. He has effectively managed complex advanced pricing agreement assignments on several MNCs. He has presented in various events organized by renowned professional institutions. He also contributes articles on regular basis at various national and international levels. He has serviced the clients across various industries, including pharma, chemical, IT, FMCG, etc. His acumen and extensive knowledge on the particular subject would provide the participants an in-depth insight on transfer pricing. With these few words, I am very much happy to introduce CA Bhavesh to the viewers. Now I request Secretary of SIRC to introduce CA Roopesh Rao to the viewers.
Thank you, Chairman. I take the pleasure of introducing one of the distinguished speakers for the day, Mr. Roopesh Rao. He is a global transfer pricing services firm partner, and he has 20 years of post-qualification experience, mostly in providing corporate tax and transfer pricing consulting services. And he is an associate member of the institute and has completed his BCom degree from Madras University. He has extensive service in advising clients on transfer pricing and international tax matters. He is actively involved in managing clients' tax compliance obligations like performing transfer pricing studies and represents regularly before the Indian transfer pricing authorities and affiliate authorities. He has been involved in assisting clients in handling APA and MAP proceedings and in representations before APA authorities. With this, I introduce Mr. Roopesh Rao. Over to you.
Thank you so much, respected chairman and respected secretary of SIRC. It's a pleasure to be here. I am Roopesh Rao. Good afternoon to everyone. So let me start my presentation. At this stage, I hope everybody is staying safe and is healthy. So let me start this presentation on transfer pricing, a very important topic in today's world. And let me just give some context to and on this topic.
Just I want to say one comment. Rupesh, I want to say one comment. So hello everyone. I think the idea over next 2.5 hours, Rupesh and I both want to. There is a concept and then there's a practical experience. Our idea is over here to share as much as practical experience that we both Rupesh and we have. So while the slides are going on, we'll try to make it more interactive. So we would love to see the questions that you all would have, and we'll try and to cover and address those. I hope this could have been in person, but if not in person, in virtual. But I think our endeavor will be that how can we make it more interactive and how can we kind of make it more relevant. Today we are cognizant that there are about 250 plus people are going to spend 3 hours on this thing, and we want to make sure that the time that you spend is well spent, and you get a at the end of the session. Certainly, there is an enrichment that should happen to you as well as to us. So we also would like to learn from you all. At the same point in time, we are here not to kind of just go through the presentation. Presentations are there, but I think it's more active engagement that we would like to have with and have an real exchange of practical knowledge in that. And again, the way we have designed our entire presentation is we are going to share our experience. Suppose if you are either in industry or in a practice, an international tax subject which is there, and transfer pricing is an important link. So certainly there is definitely for each and everyone who is going to attend this session, there is a something that is going to be of use to you. So my sincere request, just I think 2.5 hours will give us undivided attention, and we assure you that at the end of the session, you will certainly gain something out of it. Yeah. On that note, Roopesh, over to you.
Thank you so much, Bhavesh, for setting the context. Let me straight go into the presentation on transfer pricing. So at the outset, as most of you will be aware, transfer pricing applies in a situation where there are two related parties or group entities who have transactions between each other. And when these two group entities are in two different jurisdictions, one is in India and say one is in another country, then each country looks at as an objective of transfer pricing to protect its own tax base, to protect its own income as far as that transaction is concerned. And transfer pricing also seeks to achieve an objective of equitable sharing of revenues between these two countries. What we call as one could be a residence country and another could be a source country of taxation as far as that income on the transaction is concerned. And transfer pricing also seeks to achieve that there is no discrimination between how two group entities within a multinational group transact vis-a-vis how two independent group entities transact. So the concept of transfer pricing is very simple, that even if you are related parties, you should act as if you are independent enterprises. And the key objective being to avoid shifting of taxes or avail any tax arbitrage between the two taxpayers in two different jurisdictions. So every government today, there is more and more protectionist kind of approach that each government tries to protect its tax base from getting eroded, especially to low tax jurisdictions. And transfer pricing is a key mechanism which every country has its own transfer pricing law to plug those kind of tax leakages or loopholes that would be there. So we will see how the Indian, especially the Indian transfer pricing regulation works. And when you look at it from the perspective of the multinational group, right, which has
Rupesh, can I just change to slide share mode? Your presentation is not.
I'm sorry. So if you look at the challenges that are faced by multinational companies, as far as transfer pricing regulations are concerned, since each country has its own set of rules, multinationals do face a lot of challenges even when they want to genuinely transact. Because there are different TP regulations and compliance requirements in each jurisdiction, they do have business pressures to be competitive and structure their business operations efficiently. And there are a lot of, transfer pricing is not just about taxation law, but there is a lot of economics and business dynamics that you need to understand. So it is not strictly only about talking about income tax, but also getting into the business side of the transaction. And to you know for example, if a multinational is investing in a new subsidiary in India, they may need to have price their products in a very competitive way. They may have business losses in the initial years. So how will that impact their transfer pricing position for intercompany pricing of goods or services is something we'll see in this presentation. As I said, there are constant regulatory changes, and even the audit environment in terms of assessments that happen in each country is getting more stricter, and you see more controversies or more litigation and India has been in the forefront of transfer pricing litigation in terms of both volume and quantum of adjustments that have happened. And there are different intra-group transactions that multinational groups typically have, and each one comes with its own complexity, and which we will see as certain examples in these slides. And every group being reporting to their shareholder is answerable for what effective tax rate that they pay. While they want to be compliant with in each country, they don't want to pay too much taxes beyond what is really required in those countries. I think broadly this is the context of how transfer pricing plays an important role for multinational groups. And it's an evolving issue. There is no one, it's not a science, sometimes it's an art in terms of how the economics of the transactions play out on a year-by-year basis. And during this COVID challenged world, transfer pricing has become even more a challenging aspect to deal with, because all the assumptions you made on business, critical assumptions earlier, have all kind of turned on its head. So we will look at what challenges COVID has also brought in. So getting into the basic concept of transfer pricing, I think as you will be aware, Section 92 is the section, provision which talks about any. So basically, transfer pricing is a anti-avoidance regulation, and Section 92 talks about any income arising from an international transaction between associated enterprises have to be computed having regard to arm's length price. So this is the basic concept, very simple, just one line, which defines the entire transfer pricing regulations in India. And broadly, you can see transfer pricing consists of three important aspects. One is international transactions. We'll quickly see what that means. Two is associated enterprises, which is generally understood to be two related parties, but there is a clear definition under Section 92A as to what constitutes associate enterprises. And third is the concept of arm's length price. So I think most of you are aware of these concepts at a basic level, and we are not going to go through the definitions given in Section 92A or 92B, etc. But we will just get into certain nuances during the course of these presentations. In addition to these three aspects, transfer pricing also covers something called a deemed international transaction. We will look at that shortly. That may be over and above what you normally understand as transactions between associate enterprises. And there is also transfer pricing in a limited way applies to specified domestic transactions as well between two domestic entities. So broadly, this is the concept of transfer pricing, which we will cover. Just to make this a little more interactive, I'll request if the first poll questions can be shared.
It's shared now, sir.
Okay.
We'll have 30 seconds timer.
Read out the question. So can transfer pricing provision reduce the income chargeable to tax in the hands of the assessee in India? We've been told that the people on this call do have a good experience and knowledge about the subject, as well as the working knowledge about the transfer pricing and interest rate tax.
So we'll close the board now. It's crossed 30 seconds and we'll share the results. We have 80% answered no and 20% answered yes. I hope the screen is visible.
Right.
So
yes, so the concept of transfer pricing is that, I mean, if you look at it from an Indian income tax perspective, the associate enterprise on the India side, when you look at his income, transfer pricing only seeks to see whether he's reported the right amount of income or loss and not a reduced income or higher loss claim. That's the objective of transfer pricing. The other way around, in terms of where the income is higher than what it should be, is not the objective of transfer pricing. I think broadly that's what the question kind of seeks. Yeah. Bhavesh, anything you would like to add?
No, I think correct. I think answer of all the 80% people kind of rightly answered. That it's an NTS provision. So I think therefore you can't you making use of transfer you cannot reduce the income.
Yes. Right. So let's look at the topics that we are going to cover today. Broadly, what we are going to cover today is what are the basic transfer pricing compliance that companies are required to do. There is a list of things that the company by itself has to declare and maintain certain documentation. We'll look at that. And there is also an accountant's report, as you are aware, in Form 3CEB, which needs to be obtained from a chartered accountant. So that is very relevant for us. We'll go through the clause by clause analysis of the Form 3CEB today and what kind of issues are typically arise in those kind of, when you certify. There is a guidance note of the institute as well, which is kind of relied on. Then we look at some of the key transfer pricing issues or controversies during transfer pricing audits or assessment proceedings. And there, TP regulations also being part of the global, there is the BEPS regulations, which is given by the OECD. The transfer pricing aspects of the base erosion profit shifting rules has certain implications on the India side. So we'll look at that. And as I mentioned, what is the impact of COVID-19 been on transfer pricing, especially for limited risk entities? We'll look at that today. And we have a few slides on advanced pricing agreements and safe harbor rules, which will be at the end of the presentation. So I'll straight away, the first two aspects here on this topic of transfer pricing documentation and accountant's report in Form 3CEB, we will cover now. This is basic compliance that every company to whom transfer pricing applies needs to follow. So let me start with transfer pricing documentation rules as per the income tax law. So let's say a multinational group has an Indian subsidiary or an Indian entity which has related party transactions with its group entities. What does it need to do, right? So as per the Indian transfer pricing regulation, every person under section 92D, every person who has entered into an international transaction or a specified domestic transaction shall keep and maintain such information and document as may be prescribed. So Rule 10D of the income tax rules provides a list of documents that needs to be maintained by the taxpayer, Indian taxpayer. So let's look at what kind of documentation that he needs to maintain, what periodicity, what is the threshold limits, etc. is something we'll look at. As per section 92D and Rule 10D, every company, every Indian taxpayer whose aggregate value of these international transactions exceeds a value for a year of more than 1 crore is required to maintain transfer pricing documentation under as prescribed under Rule 10D, and he has to maintain, the company or the person has to maintain that documentation for a period of 8 years. So what are these documentations that have been prescribed? We can broadly categorize under 3 buckets. One is entity related information, the other is price related information for the transactions, and the third is transaction related information that needs to be maintained. And the Indian tax rules requires that the person or the company maintains this documentation and needs to be submitted when called for during a transfer pricing assessment. And this has to be maintained on a contemporaneous basis under Rule 10D. What contemporaneous documentation means is that as and when the transaction happens during the year, you need to be able to demonstrate and have this documentation to justify the arm's length nature of these international transactions during the year. So there is a fair bit of onerous documentation to be maintained by such taxpayers, and that's why I think it's good to go through what all is needs to be prepared. A lot of this information is kind of captured on an annual basis and updated on a year-on-year basis in terms of what changes happens, and is maintained as a file, what we call as a local file, or as what we call as a transfer pricing documentation. So the entity related information that is prescribed under the rules is a profile of the industry in which the company belongs to or the person belongs to, the profile of the group within which the Indian taxpayer belongs to, the profile of the Indian entity itself, and a profile of its associated enterprises. Then as far as the intercompany transactions, let's say there are purchases, sales, services, royalties, intangible assets, any interest or financial transactions, etc. All the pricing related matters for such intercompany transactions needs to be documented in detail in the transfer pricing documentation. Then you need to, what is an important, a core part of this transfer pricing documentation is what is called as a function asset risk analysis, or what we call as a functional analysis, or a FAR analysis. So we look at this a little bit more in detail because this is a little important in terms of what the taxpayer's business is vis-a-vis its group entities and vis-a-vis the industry to which it belongs to. Then you prepare something called as an economic analysis. You select a transfer pricing method to justify the arm's length nature of such intercompany transactions through what we call as a comparable benchmarking analysis. We'll look at that a little shortly. And there are other price related information to be maintained, such as budgets, forecasts, and estimates, which will help the tax officer to look at the context with which the price setting happened, right, during the year. And this transfer pricing documentation also requires transaction related documentation, such as agreements, invoices, what you will typically look at during an audit of the books of accounts where such transactions are captured, and pricing related correspondences as to how purchase orders, how the pricing has been agreed, etc. The source trail is something that needs to be maintained as part of contemporaneous transfer pricing documentation. So this is a core part of transfer pricing compliance. Bhavesh, would you want to add something here?
No, I think you covered it well, Roopesh.
Yeah. Right. So I'll move on. As I mentioned here, a core part of this transfer pricing documentation is something called a function asset risk analysis, or a FAR analysis. Let's look at what this FAR analysis typically is required. The whole purpose is to understand what is the nature of activity carried on by the Indian company vis-a-vis its group entities, and at the end of the exercise you do something called as a characterization to characterize what is the business profile. What is the business profile of the Indian entity. So what do you capture in this function asset risk analysis? As the nomenclature gives you, what are the functions performed? What are the activities performed by this Indian entity? Let's say it's the Indian entity is a subsidiary which manufactures on a contract manufacturing basis and exports to its group entities, right? So you capture as an example. Now you document the limited set of activities that are performed by the Indian entity in this FAR analysis as part of the documentation. There you do what we do as what we call as functional interviews with the company. You speak to the business operations people in the company, understand the process flow as to, you know, are you importing goods, are you procuring services from your group entities or from other third parties, do you uh, locally procure, what kind of decision making is taken by the Indian entity, how much of reliance is there on its group entities in either on pricing or key terms of the transactions or in running operations. This is something that you understand in detail by carrying out something called a functional interviews with the company or with the client, right? If you are going to prepare the documentation for your client, this is a key part of this FAR analysis, is a key part of what the documentation assistance that you do for your client. You identify the key functions performed by the parties, both at a management level, at a strategic level, right down to an operational level. And you look at what are the key performance indicators for the, you know, personnel of the Indian company. And the OECD talks about something called as a significant people function. So what are the key people functions? Who are the key personnel? What decision making they do in India? Uh, you know, as far as running the Indian business is concerned, how much dependence is there on the group entities in terms of uh, you know, people who are making key decisions? I think that's an important part of a FAR that you prepare, because what, you know, at a multinational group level, what are the key things that a tax authority will look at is that if there is significant people function performed in India, then it may consequently mean that uh, you know, the Indian entity is characterized as a higher risk bearing entity. So we looked at in the later part of the slide. The second step is to look at a mapping of the assets owned by the Indian entity. This could be both tangible and intangible assets. This is something you can look at the financial statements to see how significant uh, assets and liabilities are carried out by the Indian entity. What are the key tangible assets and intangible assets which are required for running the business is something you need to capture as part of the FAR analysis. The third aspect which is important in the FAR analysis is what are the risks borne by the Indian entity. So there are both industry specific risks and company specific risks that are to be borne. So primarily you look at the risks assumed by the Indian entity vis-a-vis its own group entities and vis-a-vis other industry players. This is both in form and in substance. When I say form, the risk can be based on contractual relationship. Let's say that there is an Indian subsidiary which provide IT services to its group entities. Then there could be an IT service contract where the scope is defined and the risks are also defined in that contract. But what is also important is to see the substance in terms of what is the actual you know, conduct of the parties. Is it in line with what the contracts mention? If the contracts say that it's a limited risk bearing entity, in practice, is it really limited risk bearing is something that you will do as part of this function asset risk analysis, right? And what are the other key business risks carried out by the Indian entity? It could be market related risks, it could be capacity utilization risk, it could be currency related risks. All this gets captured as part of this FAR analysis in the transfer pricing documentation. And what you need to see is there needs to be some consistency between what we capture as risks being assumed to the functions performed as given in the step 1. For example, if there is significant people function involved as per performed as per step 1. And if you say that, I mean, in relation to the entire group, but if you say that the Indian entity bears very limited risk, then we need to show some consistency there. We need to show how this kind of plays out between the functions performed and the risks assumed, right? So the FA, I mean, we have a couple of examples for a manufacturing and distribution operations, which I'll take you through from a FAR analysis. You may.
So, Roopesh, now a couple of interesting questions have come. I think let's take that. I'll just raise those questions. Will an Indian company with almost the same name as a foreign company be treated as AE, associate enterprise, and subject to transfer pricing provision due to similarity of name?
Right. So it's not just to do with the name. I think when it comes to whether you are an associate enterprise or not, is clearly defined under Section 92A. And primarily the Section 92A1 talks about control, management, or capital. And there are a set of conditions given. Primarily, the definition of associate enterprise gets captured based on shareholding. There are other conditions also, but just to answer the question, just because there is a common name doesn't necessarily mean that it is an associate enterprise. Bhavesh, you
Yeah. There are a few more. We'll take in a few. Yeah. You carry on.
Right. Sure. Right. So, what is the importance of this FAR analysis that we just saw? I think, as I mentioned, if you map what is the function asset risk of the Indian entity vis-a-vis its group entities, you will be able to understand the business and related commercial considerations based on which the intercompany transactions are occur. You will be able to then look at the context in which the intercompany prices have been set, and we do what is known as what we call as an economic characterization of the entities. So if the Indian entity is taking the entire market risk, we'll just look at it in a couple of illustrations in the subsequent slides. Then we call it as an entrepreneurial entity. But if it performs a very limited risk role, right? Let's say it just does as a captive IT service provider, or it acts like a captive contract manufacturer for the group. It just exports to its own group entities. Then it carries out a very limited role with limited functions and risks, right? So then we can characterize it as a limited risk bearing captive service provider or a captive manufacturer. So it's important to characterize the Indian entity vis-a-vis its group entities, which is one of the key objectives of this FAR analysis, right? This will set the base as to how we will go forward and justify the arm's length nature of the intercompany transactions in the subsequent steps in the transfer pricing documentation. So that's broadly the relevance of this FAR analysis that we perform. So let's look at examples of companies which are into manufacturing. Let's say that there is a group which is into, say, automotive manufacturing, and there is an Indian subsidiary company that is also into the business of manufacturing. So what are the kind of manufacturing, how do you kind of categorize what kind of manufacturer the Indian entity could be? Depending on this function asset risk analysis, you may categorize the Indian entity into any of these buckets, right? It could be a toll manufacturer, it could be a contract manufacturer, licensed manufacturer, or an entrepreneur. So what does this mean, right? So let's say that, let's assume a situation where the Indian entity, there is a plant and it manufactures only for its own principal, which is its parent company, right? Is in a related party in another country. If all the raw materials are supplied to the Indian entity just carries out a manufacturing process and exports everything back to its principal, who is a related party, then it carries very limited functions and limited risks. So it is on the lower end of the curve. It performs only manufacturing activity. Even the inventory function could be very restricted or very limited. It doesn't carry much inventory function or risk because it's all supplied by its principal. It sells only to its group entity, so there is not so much of a sales function, and it doesn't carry any manufacturing intangibles or any either technology or marketing intangibles because everything is provided by its principal, its parent company, and it only sells it to its principal. So you can, in those cases, you characterize that company as a toll manufacturer. A contract manufacturer carries out a little more functions and risks. It may carry more inventory risk, right? It may hold some inventory and sell it based on a purchase order. It need not be necessarily on a back-to-back purchase order, but it doesn't do so much of a sales function because still a contract manufacturer sells back to its principal, and it doesn't hold any intangibles as such, and therefore it is still a limited risk-bearing entity. So this could, as a consequence of the function asset risk analysis, you will be able to identify whether it falls in which of these categories. A licensed manufacturer is more of a company which obtains a technology license from its principal or its parent company, but then it takes its own decisions on how it does the sales. It may sell it to unrelated customers in the domestic market or export market. It has more autonomy in terms of what kind of decision it takes. So this could be a more higher risk bearing entity. So this entity may have either profits or losses, while the earlier two, you would expect that they should be profit making, albeit a very limited routine kind of a profitability. While a licensed manufacturer, since it bears more risk, it may have higher profits, or it may even have lower profits or losses, but it may not carry so much of intangibles because the intangibles are provided by its principal in the form of a license. That's why it's called as a licensed manufacturer. License could be a technology license, it could be a brand in which it sells, etc. Right? And then the last category in the spectrum is an entrepreneurial entity, which carries all the functions and risks, and therefore it functions like any other independent third-party company, and therefore it could be profit making or loss making. So the way you categorize plays an important role, and how you categorize is based on the FAR analysis. Right, Bhavesh, you want to add something?
I'd like to come over here. Now, typically in a transfer pricing, when you're doing a benchmarking, ideally you're supposed to benchmark the margins of the simpler entity. And therefore, the entity which is an entrepreneur entity which is making a decision, because the profit outcome of the entrepreneur entity is dependent on multiple factors. So typically, you should never be benchmarking the profit margin of entrepreneur. You should be benchmarking the profit margin of the simpler entity. But by nature, I think generally what happens, because of lack of data and because of it's a more simplistic to take an Indian entity as a tested party, you would see in majority of the cases, the Indian practitioners end up benchmarking the Indian entity, which logically applying the correct transfer pricing principle may not be right. As an entrepreneur entity, that should never be taken for testing the profit, and it should always be a simpler entity like a toll manufacturer, contract manufacturer, that should be taken. Yeah, Roopesh, I'd like to take another question over here. The question is, please confirm the importance of having a separate TP agreement and mentioning the percentage of margin in such agreement. Can we mention a margin range as well? So the question effectively is, when you suppose you're as a manufacturer or suppose as a LRD or a contract manufacturer or license manufacturer, when you're entering into a contract, does the taxpayer need to specify the exact margin? Does the taxpayer need to specify the range of margin, or there could be any other way the contract is made up?
So see, the an intercompany agreement between related parties seeks to define what is the terms with which the transaction takes place. Typically, if if you are able to define the price, the basis of arriving at the price, the better it is. But at the same time, we've seen groups which, uh, again, it differs between goods and services. Typically, we've seen intercompany agreements for services is a standard practice. And you can have a basis with which you arrive at the a profitability margin, or the basis with which you arrive at your pricing. You may have some flexibility in the agreement. There is no hard and fast rule that it has to be at a specific price, because the market dynamics also change, or on a year-on-year basis, the industry performance may also change. So there is no hard and fast rule. Generally, you do have intercompany agreements for services. Depends on what is the methodology. Are you going to do it on a cost plus basis, or is it going to be on a per man monthly basis if you're doing services? Or in the case of goods, is the price fixed based on a price list, or is it going to be based on your production cost plus, etc.? Is really dependent on how you agree between the parties. What is important is you need to have something called as a transfer pricing policy. Generally, groups have a transfer pricing policy, and you try to align your pricing based on that group transfer pricing policy. You can still have a range to give you some flexibility, but then when you actually transact, you may probably have an addendum to say, during this year or during this period, I will follow this pricing methodology and I'll review it from time to time. That's also possible. So you may have a master service agreement, you may have an addendum or a SOW.
And also in a few cases, we have also seen where the groups are kind of, where there are a lot of external factors. The groups also mentioned that the pricing based on the arm's length study to be conducted, and they price particular this thing. But by and large, generally there is a fixed margin for service transactions which are there, and certain places there are this thing. So there is no one rule fits one size fits all. It depends upon which business line you are belonging to and how stable the business is. And if you're able to predict the profitability outcome very well, then I think one can specify the margin. Otherwise, best to have a more broader range, or to say it's an arm's length, and actually then back it up with the arm's length study.
Right.
Yeah, Roopesh, continue.
So thank you. So let me give another example, like we saw for manufacturing, how the FAR analysis helps you to categorize, what kind of functions and risks are being performed. In the case of distributor companies, you would have seen companies that do buy and sell. There are various factors as to how, is it a commodity? Is it a proprietary brand? This plays a role, right? What goods or services you are acting as a distributor becomes important. And what is your role, right? So the least functions and risks are what is called as a marketing support service provider. This entity does not actually do buy and sell. What it just does is it provides some marketing support in terms of licensing support, uh, and connecting its principal, which is the parent company or its group entity, with potential customers in the Indian market or wherever. So it carries out very limited risks and acts more as a service provider. So it doesn't really take inventory of the goods in this case. While the second category is more like an indenting or a commission agent, where as an agent it has certain authority to bind its principal or not. That depends on what the agreement is. But again, it will still have limited risks. These agency relationships, of course, from a tax perspective, have other consequences in terms of permanent establishment, etc. So you need to be careful how you fix these arrangements. But it really depends on the intensity of functions that is performed by the Indian side of the company. Is it acting as an agent? Is it acting on a principal to principal basis? The third category is more common, where we call it as a limited risk distributor. Again, as a subsidiary, if it is going to import from its principal or its parent company the goods and sell it in the Indian market, and if it still carries out very limited risks in acting as a distributor, then we call it as a limited risk distributor. That depends on what is its functions, what is the role it plays, what is its authority. If if it carries out very limited risks or limited functions, then it may get an assured return on its sales. So the consequent intercompany pricing methodology will depend on how you categorize these manufacturers or distributors or service providers. And the last category in the spectrum is a entrepreneurial, or what we call as a full-fledged distributor, which is a complete risk-bearing distributor. So as far as the parent company principle is concerned, it just sells based on order given by the distributor. It is up to the Indian distributor company to see the market, import as is required, and sell it in the market at the price at which it is able to fetch from the market. So it carries full market risks. It may carry significant inventories, and therefore it may have higher profits or lower profits depending on how the market behaves and how it is able to position itself, among its competitors. So again, this is an example in a distribution setup as to how you can categorize based on your FAR analysis in which category you position. This is something you kind of typically document in the documentation, that it falls within one of these categories or somewhere in between these categories. It will help you to assess how you are able to justify the arm's length nature of the intercompany transactions that these companies have, right? So that is as far as
another question over here. How do we get comparable companies for toll or a contract manufacturer to determine the ALP?
Sorry, I couldn't follow that. How do you?
The question is, how do we get comparable companies for toll or contract manufacturers to determine the ALP? So how do one find comparables for toll or contract manufacturers?
That's a good question. That's a very good question. And there are limitations. So firstly, as Bhavesh mentioned, if the Indian entity is a limited risk entity, then we will look at this concept of tested party that comes in the subsequent slide. Then you are able to test the margins or the pricing of the Indian side of the transaction with comparable companies who perform similar activities as the Indian company. So in an ideal world, you try to use companies which are close comparables, which are quite similar to the activity or function that you do. So if you are a toll or a contract manufacturer, you try to identify companies that are also toll or contract manufacturers. But in the real world, it doesn't happen. You don't get very close comparables. You may have to compromise based on what kind of comparable companies that you get in the public domain using databases that is popularly used. You may have to make some economic adjustments depending on your profile. If you are a risk bearing, or if you are a limited risk entity and the comparables that you are able to find is not limited risk bearing but is high risk bearing, then you try to see if you can make some economic adjustments to it. It really depends on what kind of comparables you get. So to answer your question, will you get similar toll manufacturing companies? In our experience, yes, I agree, you may not get. You will get more risk bearing entities, but it gives you that leeway to say that, look, I am a low risk bearing entity. This comparable company is number one or number two in the market, therefore they command a premium. You can't directly compare me with them. You may have to make some adjustments before you make that comparison. So it at least gives you that opportunity to make that argument.
And one can make one can make an adjustment for inventory, for debtors, for various other expense line item. If suppose you are a contract manufacturer, certainly you're not taking a debtor risk. So then in that case, you can make a working capital adjustment in the margins of the entrepreneurial company. And after kind of taking away those margins, then you can at least, while that may not be exact comparable, but at least you can come to some broad sense of comparable by making work adjustments on account of the differential. Yeah, Roopesh. Yeah.
That's a good point. So that's where the this FAR analysis and documentation really helps. You're right. Right.
Yes.
So moving on, the transfer pricing rules prescribes specific methods that have to be applied. One of the methods to be used to justify the arm's length nature of these transactions. So the prescribed methods, as you will be aware, there are 5 methods plus one additional 6th method that was prescribed. What is called as traditional transaction methods, the comparable uncontrolled price method, where we're not going into the details of each of these methods. I'm assuming that you must be aware of these, how these methods work. But basically, the comparable uncontrolled price called as a cup method, which means that you are able to identify at a price level a directly immediately comparable transaction. For example, you sell to your related party and same goods under same economic circumstances you sell to a third party. You compare both the prices. That is the cup method. But again, in the real world, this may be difficult to apply this cup method because the economic circumstances may be different between how your functions and risks would be different when you sell or purchase from your related party vis-a-vis similar transactions with third parties. So when you're not able to get an immediate comparable price, then you resort to these other methods. This resale price method is more used in the context of a distributor where you buy and sell. That's why it says resale price. You typically use gross margin methods to compare your gross margin profitability vis-a-vis those of comparable companies that you identify, who are comparable to your business or functions and risks. And then you have the cost plus method, which is typically used in a manufacturing company. You take what are the direct and indirect costs of production for the manufacturer, compare how much markup on such direct and indirect cost of production that you earn vis-a-vis those of other comparable companies, to justify whether the margins are at a comparable level as against the industry. Then there are transactional profit-based methods. What is called as a profit split. The profit split applies in very unique situations where both sides of the transaction, the Indian side and the other related party, both jointly own certain intangible property or intangible assets, and contribute both to the routine and non-routine profitability that arises out of the transaction. The profit split method is fairly rare in how it is used. But one of the most popular methods, for convenience purposes, that is used is called the transactional net margin method, where you take the net margins earned by the company in a transaction as against net margins earned by comparable companies in the industry, and try to justify. You may need to make some adjustments when applying those net margins and comparing them, but that's a very popularly used method, which is one of the most popularly used methods, right? So anything you want to add here, Bhavesh?
No, I think you covered well. Maybe I would like to, there are, I think, good number of questions are coming up, and I thank the audience for that. We will take quickly a few questions over here. For whatever. Can we use the internal cup for a services? Can we use the internal cup for services? So you want to answer that?
You can, yeah. Go ahead.
Okay. Yeah. So yeah, we can use the internal cup for services. It's possible. It not the cup only has to be used for a products, but even for services it can be used. Is there any safe harbor norm for toll or a contract manufacturer? Yeah, there is a safe harbor norm for a contract manufacturer of a pharma contract manufacturer, but not for all generic contract manufacturers. There is no such safe harbor which we have.
Auto components also.
Yeah.
Pharma and auto components. But, but practically we can say that the safe harbor for manufacturing is very rarely used, because the safe harbor margins that are prescribed are very high. It's generally considered to be much higher than the industry. and it is not adjusted on a year-on-year basis based on market performance. So companies don't, and there are very limited situations where these can be used.
Okay. One again very interesting question from Mr. Nageshwar Rao is based on a FAR analysis, overseas subsidiary seems to be less risk entity compared to Indian parent entity. In that case, can we take overseas entity as tested party? If so, how do we benchmark parent entity with the overseas unrelated entities? Maybe I'll answer the question. So, Mr. Rao, certainly if overseas entity is least complex entity, then we take that entity to benchmark the margin. And in such case, what we should do, we should take a comparables of overseas countries. There are databases available, CompuStat, Osiris, the database available. In such cases, for typically, let's say when parent entity is rendering management services, or the entity, there is a common IT, common entity which is rendering IT service for the group based in Singapore or some other geography. We take that overseas entity as tested party and do a search in the database, like global database available, where you take a companies operating in Asia Pacific region and you do a benchmarking of those transactions. So foreign companies taking overseas entity as tested party, there is no judicial precedent also confirming that. And earlier the Indian tax authorities were opposing to taking overseas comparable, but however now there is several judicial precedents which have upheld that view. Yeah, Roopesh, carry on.
Yeah. That's a very interesting question, and it's a increasingly there is more acceptance to looking at the real economic characterization of companies, and if the overseas, especially India-based parent companies having subsidiaries, what we call as outbound subsidiaries overseas, you will see the Indian company to be the more entrepreneurial or risk-bearing entity. So the overseas subsidiaries, you can test their profitability or their side of the transaction. There are limitations in getting comparable data for in those jurisdictions, but today increasingly such information is being available. Right? So that's an interesting part of transfer pricing, and that's a good question. So coming back on these methods, I think you need to look at practical considerations in applying these methods and then doing this economic analysis, as we call. I think the important part of this transfer pricing documentation is obviously to justify the arm's length nature of these international transactions. So by applying one of these methods, and when you do that, you need to look at the context, the commercial considerations surrounding that international transaction. Is it a startup company? Is it a mature company? Does it have losses or profits? What is its market positioning? Is it, if it is a entrepreneurial company, is it what is its positioning in terms of its competitors? Is it at a market penetration stage? All this will have an impact on its profitability, and thereby it will, when you do this net margin analysis or gross margin analysis comparing with competitors, you may need to take these factors into consideration before actually doing that comparable analysis, right? And what are the roles and responsibilities of the associate enterprises vis-a-vis the Indian company has to also be documented clearly. What is the group transfer pricing policy in relation to such intercompany transactions has to be considered when applying the method. Who are your key competitors? And when applying some of these methods, now what all intercompany transactions can you aggregate, or should you test each transaction individually or separately is a very important question, because business as a whole, you buy, you import, you purchase locally, you sell in the domestic market, you sell in export market, everything, all this could be interlinked, right? You cannot see each transaction separately. If you look at it at a net margin level or a gross margin level, how much can you segment and how much can you aggregate becomes an important discussion. That depends on the context of that business and the context of that transaction. So that's something that you need to see, whether you will do the benchmarking exercise at a segment or a function level or at a larger entity level depends on that context. Bhavesh, you want to add anything here?
No, I'm good.
So as we mentioned earlier, before you even embark on applying these methods to justify the do that benchmarking exercise to justify the arm's length nature of the transaction, you need to determine the tested party. So there are two sides to the transaction. One side is in India, the other side is in the other country or other group entity in the other jurisdiction, which is so the tested party, the party to whose margins you test or whose price you test, is the one whose information is readily available and reliable and accurate comparable data is available for on that side. So that's why the Indian side is the most easiest one to test, but not necessarily that it only has to be the Indian side. And what is important is to see which is the least complex entity, as we just discussed earlier, on the two sides. So the one which is more limited risk entity, you typically test that side of the transaction, and where you get comparable data with minimal adjustments. So these are the tests that you typically do to see which is the tested party to the transaction. And typically you do not test an entrepreneurial full risk bearing entity, should not be selected for benchmarking. You test more the limited risk bearing entity. Right. So this concept is very important in a transfer pricing documentation analysis. So I think in the interest of time, I'll move forward. I'm sorry, Bhavesh, I'm not able to see the questions. If there are any further questions, do.
Yeah, there are questions I will keep popping, but I think as you rightly said, we'll just need to be a little bit more faster.
Yeah. So let me quickly get into another concept under the transfer pricing regulation, which is called as a deemed international transaction. So as we saw under section 92A, you defined what are associate enterprises, mostly related enterprises by shareholding, management, or control. And section 92B defines international transactions to be transactions between two associate enterprises, right? Where one of the associate enterprises is a non-resident, right? That's the definition given under section 92B1, subsection 1. There's this subsection 2, which talks of a situation where two third-party entities could also be deemed, there is a deeming fiction here, to be related to, to be covered under this international transaction definition in very limited circumstances. This is a circumstance, as you can see here in this illustration. You have ABC US having a subsidiary in India, ABC India, but the transaction is not directly between ABC India and US. The transaction is between ABC India and another entity in the US, X Limited in the US. Now, even though these are two third parties, if ABC India and XYZ US are transacting based on a prior agreement between XYZ US and ABC US, right? My related party, ABC India's related party, then you are only interposing a third party to overcome this transfer pricing regulation. Therefore, this deeming fiction says that if you act based on a prior agreement with your own related party, but you transact with the third party, it still gets covered under this deeming fiction. So what this definition says is there exists a prior agreement in relation to the relevant transaction between such other person, which is XYZ Limited, and the associate enterprise of the taxpayer, or the terms of the relevant transaction between ABC India and XYZ US are determined in substance between such other person, which is XYZ US, and my AE and my associate enterprise, which is ABC US. So typically you see a lot of these practically you see as a group my parent company may have a master service agreement to provide services or to procure certain goods from a certain company globally, and the Indian subsidiary may, under that same global master service agreement or master contract, could procure goods from that third party, but based on what the third party agreement is there with my parent company. So those kind of transactions get covered under this 92B2. You would have to keep a lookout for such transactions because you would have to report this in that Form 3CB which we spoke about. So there are some case laws. I don't want to get into the details, but basically what you need to keep in mind is to see that even if there are third-party transactions, are they conducted based on prior arrangement with my associate enterprise, then it can get covered under this section 92B2. Right. So I'll quickly uh, move on. Bhavesh, you have any other comments on this?
No, we can carry on.
So let's carry on. So again, domestic transfer there are a limited set of situations where transactions with domestic entities two Indian entities could also get covered. But this has become more restricted. Earlier, even transactions which were covered under Section 40A(2)(b) of the Income Tax Act fell under the definition of domestic transfer pricing, but that has been omitted by Finance Act 2017. Today, this domestic transfer pricing applies only in the case of tax holiday companies. So companies that avail tax holiday like Section 10AA that an SEZ unit avails, or Section 80IA, etc. There are provisions under subsection 8 and subsection 10 of 80IA, which says that the where there is transfer of goods or services between a tax holiday unit or a tax holiday company and a non-tax holiday unit or company, then those transactions need to be based on market pricing. And as per this domestic transfer pricing rules, you apply transfer pricing methods that we just saw to justify that the tax holiday unit or company is not earning excessive income, so that you don't leverage on this tax holiday rules to gain on excessive tax holiday claim. You need to justify that those two tax holiday and non-tax holiday units are acting on arm's length basis. That's the whole purpose. You apply similar transfer pricing methods to justify that. This also gets reported and covered in the Form 3CB certification that we just spoke. So let me quickly go into this Form 3CB certificate. I think that's very important. As chartered accountants, if you are certifying in Form 3CB, we are covered under the guidance note issued by the ICAI Institute. So let's look at what gets reported in this certificate under Section 92E, right? So this transfer pricing certificate under Section 92E in Form 3CB, it looks like this, is obtained by every person. So even if there is technically even 1 rupee of international transaction, as we saw, or specified domestic transaction, you would need to report such transactions in this Form 3CB. Of course, this domestic transfer pricing, there is a threshold limit of 20 crores again, so that applies in very specific situations. But international transactions, even if there is 1 rupee of transaction, technically you need to report it in Form 3CB. And the chartered accountant who's certifying in Form 3CB gives an opinion that appropriate documentation which we just saw is maintained, and he reports that each international transaction is reported in this form, and he gives this report that it is true and correct. So there is an onerous responsibility. You obviously have to carry out all the audit checks as given in the guidance note for each of the transaction. You do a sample check you look at various disclosures in the financial statements. You look at group entities, ledgers, etc. You do an audit you obtain the information from the client. You do an audit check, and then you issue the certificate. The important part is that you are reporting that all the documents are maintained, and you report that it is true and correct as given in the annexure. So let's look at what each of these clauses say. So the Form 3CB is broadly the report which we just saw, and the annexure contains 3 parts: general information, international transaction, and on domestic transactions. The part A is very simple. It gives each clause in terms of the name, address, PAN, etc., the nature of business, the status of the company, the previous year and assessment year, what is the aggregate value of transactions, international transactions and domestic transactions, is reported in part A of the Form 3 CEB. But part B is where all this information gets reported to. If you look at part B of Form 3 CEB, which is now in the electronic form, there are various clauses where you need to report various aspects. So the first one is on clause 10, which gives a full list of these associate enterprises which need to be reported in clause 10. So one of the questions is, if it is an AE only for one part of the year, let's say that there is a shareholding change that happened at the end of the year, right, which made one of the entities as a group as an associate enterprise as per the definition under section 92A. Do you need to report it as an AE in the Form 3 CEB? The answer to that question is yes. Even if for part of the year, if you are an AE, you will still need to report it as an associate enterprise in Form 3 CEB. And as per the guidance note, you shouldn't just rely only on the disclosure made in the financial statement of related party transactions, but in addition, you should also do a test check of whether there are any other additional list of entities, group entities, which could fall under the definition of associate enterprise, and report them as well, right, under this clause 10. Moving on, from clause 11, you start reporting the actual transactions with these associate enterprises that the taxpayer has. Clause 11 relates to transactions in relation to tangible property. So 11A talks about purchase or sale of raw material or consumables with those associate enterprises. 11B talks about purchase or sale of trading of finished goods. 11C talks about tangible, movable or immovable property or lease of such property. Here, some practical considerations are you need to also report quantitative details. Now, what we've seen is it is very onerous. There could be multiple types of raw material or finished goods which are sold. They may not be homogeneous set of units. So how do you report all the kind of quantitative details becomes very onerous. So if there are too many different types of quantitative details and you are not able to provide them, the accountant may rely on representation from the company to say that the quantitative details are too much varied in kind, and make an appropriate representation in the certificate accordingly. There are other issues in terms of during reporting. How do you report goods in transit? One position as that is typically taken is that the closing goods in transit is included and opening goods in transit is excluded, and whatever position is taken as to how GIT is either reported included or not can be disclosed as a form of a note below under clause 11. That is a good practice to follow, so that the reader knows whether it includes goods in transit or not, right? Moving on to clause 12. Clause 12 talks about intangible property as against tangible property in clause 11. So this is typically about transactions like royalty, license fee, which is paid for lease of intangible assets. Either you pay for it or you receive royalty, etc., reported here. And I think as someone rightly asked, how do you benchmark? Because in the Form 3 CB, you also mention what is the method you use in this clause to justify each transaction. So, for example, in clause 11, you will say what method for this transaction of purchase or sale. You use a transactional net margin method or a resale price method, etc. Similarly, if you are having an intangible property lease like a royalty, etc., you need to give what is the method you use. There is generally some challenges as to how you will justify intangible properties. There are different methods. If you aggregate those transactions under a transactional net margin method, that's one way of looking at it. But there are challenges during transfer pricing audits where tax authorities may not accept that. So you may need to individually do a benchmarking for such intangible royalties. And there are some global databases that you may use to justify such intangible payments that you may make. And again, all intangibles need not be necessarily reported in the books of accounts. So do you need to report any intangibles that are outside the books of accounts is also a controversial issue as far as clause 12 is concerned, right?
Rupesh, just one announcement I want to make. I think, friends, we would right now we are at 6:20. I think before 7 o'clock, 10 minutes break we will have. So maybe around 6:45, 6:50, we will have a 10-minute break. We'll listen. Rupesh, continue.
Sure. So I'll move forward quickly. In clause 13 of the Form 3 CEB pertains to services, where you either provide services or receive services, you pay or receive towards services. You need to report it, to where you provide or receive services to related parties or associate enterprises. Now, typical practical issues here are there are situations where the withholding tax or the TDS on such services is also borne by the Indian SSE. So should you report that on a net or a gross basis? Could are some issues that we have seen. Typically, if that is borne by the Indian entity, you would need to report it on a gross basis because you are paying that withholding tax on behalf of your associate enterprise. And other issues you may see are you may render services to different associate enterprises, but you may raise invoice to only one. Do you report all those different AEs, or do you report only to the AE to whom you bill? Typically, you will have a service agreement with only the AE with whom you bill. So you would, even if you render services to other associate enterprises, you would record it in your books of accounts as a receivable or a payable to that and AE with or associate enterprise with whom you have your agreement, with whom you raise your invoice. So you would only report as per the books of accounts typically. So these are some of the issues you may see when reporting under clause 13. Again, clause 14 is about transactions pertaining to financial transactions of lending or borrowing money, advance payments, deferred payments, etc. Again, you typically report the interest on loans or borrowings paid or received. Interest on overdue receivables. This is another important topic because if you have any terms in your, say, purchase of goods or you sell goods to your associate enterprise, and there is a credit period mentioned that within, say, 60 days you need to receive the payment, but the payment comes after 60 days. Let's say it comes after 80 days. Then you would have to charge an interest on overdue receivable. In an arm's length scenario, would you need to charge interest on overdue receivable? How do you report it? Something you need to see in those kind of circumstances. So you may not have actually charged it, but in an arm's length scenario, if you have to charge it, you need to kind of report that under this clause, right? And again, do you need to report the principal amount pertaining to the loan, or is it only the interest? See, the objective of transfer pricing is to only look at, there are a lot of case laws also in this respect, that the income is what is getting tested. So the principal amount does not generate income. So you can argue that I don't need to disclose the principal amount, only the interest payment or income is what you disclose. But it is also a good practice to probably show it in the form of a note on the principal amounts as well, so that there is adequate disclosure and you avoid the risk of any penalties. So I think the key aspect of this Form 3 CB is that there are penalties on the taxpayer if you do not report or misreport or underreport, which you have to keep in mind. Therefore, it is important to ensure that you err on the side of caution and report as much as possible in this Form 3 CB certificate, right? Clause 15 is on transactions in respect of guarantees specifically. So guarantee is where, let's say the Indian entity takes a loan from a bank, but the loan is taken based on a guarantee given by its parent company to the bank, either through, say, a standby letter of credit or through a letter of comfort, etc., based on its relationship with the bank. Then even though you're transacting with a third party bank, uh, since there is a guarantee from your associate enterprise, you need to report that transaction. Is there any guarantee fee you pay, and how do you benchmark that guarantee fee to be at arm's length, is what needs to be reported under clause 15. Clause 16 is specifically with respect to marketable securities, equity shares, convertible debentures, preference shares, etc. So any sale or purchase of marketable securities, shares, preference shares, debentures is reported under this clause, and any buyback of shares, bonus shares, etc., everything gets reported under this clause 16. So let me just quickly move on to the other more complex clauses, or where there are more issues. Clause 17 pertains to transactions in relation to mutual agreement or arrangement. So this typically applies where there is a allocation or sharing of cost by the group. Let's say that at a group level, the parent company incurs certain centralized costs, and it allocates those costs to its subsidiary as a management fee or on a cost allocation basis. Because the Indian subsidiary is also receiving certain centralized services, where such allocation of cost happens based on a cost allocation basis, it falls under this clause of what is called as a mutual agreement or arrangement. And if this doesn't apply where there is a one-to-one service, if one associate enterprise provides services to the Indian company, you don't report it here. But if the one group entity provides to multiple subsidiaries or multiple group entities and allocates those costs on a scientific basis, then it gets reported under this clause. Right. So another important clause which you need to have a lookout for is clause 18, which is transactions arising out of a business restructuring or reorganization. Now, what is a business restructuring is not specifically defined under the Indian transfer pricing law, but you can refer to OECD guidelines. But really, what do you report under this clause under business restructuring becomes important. What the OECD defines a business restructuring is, it could be an operational change or an organizational change. So do you report if there is a change in shareholding, or do you report if there is a change in your function asset risk profile as compared to the earlier years, right? So typical, and why do you report this business restructuring? Because if there is a significant change in the operational profile of the Indian entity, you need to see if there should have been any compensation for such business restructuring. Has there been any consideration flow that has happened because of business restructuring gets tested under this clause. So typical examples of business restructuring are where the Indian company, say, is converted from a full-fledged manufacturer, we just saw those examples in the earlier slides, to a contract manufacturer, right? So that means there is a significant change in the function asset risk of the Indian entity, where in the earlier years it was acting as a full risk-bearing manufacturer, and then suddenly this year, based on a contract or otherwise, it is converted into a contract manufacturer. So this is a little tricky subject, but it's a very vast subject. I am not going too much into these details, but you need to have a lookout if there is any significant shift in the FAR, that you will know when you do the documentation, and you may need to report this as a business restructuring. And as a consequence, is there any consideration flow that has happened or should have happened also needs to be reported here. Other forms of organizational restructuring, which could be any merger, demerger, also gets reported under this clause, right? Bhavesh, you want to add anything here?
No, maybe I think we'll cover in a Q&A. There are again some questions are coming.
Sure. Okay. So I think this is an important topic. Any questions, we are happy to answer there. Then there is a residual clause called clause 19, where all intercompany transactions which didn't fall under the earlier clauses get reported here. Typically, you need to have a lookout for any free of cost transactions as well. So let's say that associate enterprise has given some assets free of cost or on a loan basis without any consideration. You may want to disclose such transactions either in the form of a note or as a transaction with no consideration under this clause 19. Any prior period reversals may get reported here. Even ESOP related transactions, what happens is sometimes the employees of the Indian company may be granted ESOPs on a scheme which is there with the parent company. So do you report it here or under clause 16, depending on the nature of that scheme and nature of the transaction? You need to see if that needs to get reported, because those costs relating to ESOP may be pushed down to the Indian entity to be borne by the Indian entity in relation to its own employees. So that is something that you may need to have a look out for. Even any receipt or payment of dividends. Now, as you are aware, dividend declaration is a appropriation of profits, so it doesn't have an impact on the taxable income. Still, you may just want to report them under clause 19, as it's still an intercompany transaction, but there's no consequence on the taxable income as such. So clause 19 being a residual clause, and clause 20 is basically the deemed international transaction, which we already saw in the earlier slides. So here you may report transactions with entities which may be third parties, but falls under the definition of section 92B2 under the deeming fiction, as we just saw earlier. That gets reported under clause 20. Then clause 22 and 23 talks about these domestic transfer pricing. We're not going into too much details here because very limited circumstances where there's a tax holiday unit, you may just need to keep a lookout for seeing whether the Indian entity has a tax holiday unit and a non-tax holiday unit, and anything gets reported where it crosses the specific threshold of 20 crores in aggregate. Any inter-unit transfer of goods or services need to get reported, and you need to justify that the tax holiday unit did not earn more than ordinary profits as defined under section 80IA 10 or under section 10AA, right? And you need to test it using transfer pricing methods. So I think this is largely on the Form 3CB clauses. Any questions we are happy to take in terms of reporting under Form 3CB. There are just two additional concepts I'll quickly want to cover, which are important, which are developments that have happened in the last few years. There is a concept called secondary adjustment under section 92CE, right? Now we are talking about a situation where the taxpayer has reported his international transactions in his Form 3CEB. He submitted a transfer pricing documentation saying that his international transactions are at arm's length. Let's say that he sold goods worth 10 crores and he says they are at arm's length. He's used a method, and then he goes through a transfer pricing assessment, right? And during the transfer pricing assessment, where it gets referred to a transfer pricing officer, the assessing officer or transfer pricing officer says that the export of goods you made, you earned 10 crores for export to your AEs or related parties, you should have earned 15 crores, right? Let's say he makes an adjustment, he applies a different method, and he says you should have earned 5 crores more, right? To the extent of the additional 5 crores, you have an additional tax liability. Now, the taxpayer does not agree. He may go for an appeal. He may go to CAT appeals or dispute resolution panel, or the second level to the tribunal, etc. Finally, this transfer pricing adjustment that was made as a consequence of this assessment order may get either deleted or confirmed either fully or partly by the appellate authorities. And let's say that at a income tax tribunal stage, this 15 crores or this 5 crores of transfer pricing addition or adjustment gets confirmed, right? Now the assessee does not appeal further. It attains a certain level of finality, right? That he has to pay tax on that 5 crores. So that additional 5 crores over and above the 10 crore value of transaction is called as a primary adjustment that is made by the tax officer. And when a primary adjustment happens, what happens is that there is a mismatch between your books of accounts, which showed that the Indian entity did export for only 10 crores, while the tax books, as per the tax return or the tax assessment order, the income should have been 15 crores, right? Now, to the extent of the additional 5 crores, what section 92 CE of the Income Tax Act says is that there should be something called as a secondary adjustment. What secondary adjustment means is that once such primary adjustment achieves the level of finality, that there is no further appeal, etc., it gets confirmed. You not only pay tax on that additional income of 5 crores, but you also adjust your books. That what that means is that in this example, the Indian entity has to receive that additional 5 crores of income from its associate enterprise to match its books of accounts with the tax books or what is finally confirmed as a tax adjustment. Now, this secondary adjustment rules applied from assessment year 17-18 onwards. There are certain exclusions for primary adjustments which were made for years prior to AY 16-17. The secondary adjustment rules does not apply, which means that you don't need to bring in this additional money into India. And it does not apply, the secondary adjustment rules does not apply where the primary adjustment doesn't exceed a value of 1 crore rupees, right? There is a threshold limitation that is there. And the secondary adjustment, basically ensures that the excess money which is lying with your associate enterprise should be repatriated back to India within a prescribed amount of time, right? So let's see what is this prescribed amount of time. What this rule, section 92C read with rule 10CB says is that this excess money in this example of 5 crores should be brought into India or repatriated into India within a prescribed time limit of 90 days. This 90 days kicks in from a specific period of time. In this example, let's say there is a final order by the tax tribunal and the assessing officer gives a final order giving effect to a tax tribunal to say that 5 crore is the final additional income on which I am assessing a tax on you. So from that date, when you get that assessment order, you have a 90-day time limit within which you have to bring in that additional 5 crores as a secondary adjustment repatriated back to India. If the Indian taxpayer does not bring that money into India within that 90-day time limit, then beyond that 90-day time limit, it is considered as an interest-bearing advance. That is an advance given by the Indian entity to its parent company, and there is a imputed interest that it has to receive. If that international transaction was in Indian currency, then that imputed interest is at a 1-year MCLR, SBI MCLR, plus 3.25% of interest beyond that 90-day period. Or if that international transaction is in foreign currency, the interest rate should be at a 6-month LIBOR plus 300 basis points. This is prescribed under the law. And so I think this is a very important provision that came since 2017. So what this means for taxpayers is not just that if you go through a transfer pricing assessment and you get an adjustment, you just pay tax and interest on that additional adjustment. You would also need to, if that attains finality, that adjustment, you would need to also repatriate money to adjust your books of accounts. So this has an impact on your books of accounts, your financial statements in the year when such adjustment attains finality, and you have to bring in the money into India, right? There is also a exception leeway given that in case this money is not brought in within a 90-day time frame, then an additional tax at the rate of 18% plus surcharge and cess can be paid. Over and above the tax on the primary adjustment, you pay another 18% plus surcharge and cess has to be paid as secondary in lieu of secondary adjustment if you are not able to bring in or repatriate the money into India within that 90-day timeline. So I think this is an important provision which we wanted to bring to your attention, which you may need to be aware. Any questions on secondary adjustments, we are happy to answer at the end of the session, right? Bhavesh, I'll just go to the next.
Roopesh, I think maybe you take this and then we will maybe break for 5 minutes. There's a last thing we'll take it because there are a lot of questions. I think we'll spend like a last half an hour on answering the questions. Very interesting questions.
Right. So let me bring in another important issue, which is not exactly under transfer pricing regulations, but it applies for associate enterprises. So this was brought into law recently, section 94B, which in global parlance is called as a thin capitalization rules, which basically seeks to see that, you know, an Indian company, if it has to raise capital, it could either be equity or debt or a combination of the two, etc. Right? So if you have equity, you pay dividend, or preference shares, you pay dividend, which is not tax deductible. But if it is a debt, let's say it's a debenture or a external commercial borrowing, etc., to your you take external commercial borrowing from your parent company or group entity, you pay interest, which is tax deductible. So some companies are excessively leveraged, where they pay a high amount of interest, which and claim a tax deduction. And globally, many countries have what they call as a limit as to how much leverage you can have or how much debt equity that you can have, 1:4, 1:3, etc. Right? The various ways in which you try to limit how much of debt you can have or how much interest deduction that you can claim. So, one of the BEPS action points also, was in relation to, anti-avoidance rules as to how much debt is or interest on debt can be allowed. And India brought in the section 94B, where there is an interest or similar consideration in excess of 1 crore, which is being claimed, where that interest is paid on a loan from a non-resident associate enterprise or from a loan from any other lender, which is guaranteed implicitly or explicitly by your non-resident associate enterprise. Then there is a limitation as to how much interest deduction you can claim. That limitation is that the total interest paid or payable should not which is in excess of 30% of your EBITDA, which is earnings before interest, tax, depreciation, and amortization. So let's say your EBITDA is 100, and your interest that you pay is say 40. Then up to 30, you will be allowed interest deduction, subject to, of course, transfer pricing regulation justifying that it is at arm's length. But the excess of 10 over and above that 30 will be disallowed under this section 94B. And you can carry over that excess 10. You will not get a tax deduction up to that 10. You will get it only up to 30. And that 10 you can carry over for a subsequent period of 8 assessment years. So let's say the subsequent year, this 30% of EBITDA works out to say 25. Then whatever you carried over from the earlier year, 5 rupees you can carry it over this year and claim it as a deduction in the subsequent year. You can do this for up to a period of 8 years. So the objective is to limit how much of interest deduction is claimed, and it's an indirect way of limiting companies from being excessively leveraged and claiming an arbitrage on the interest on loan. So this is also an interesting provision. You have to keep a lookout. There's no reporting like in a Form 3CB here. This is more during a tax computation of the company or filing your tax return. You need to be aware of these rules, right? So we thought we'll bring this also to your attention. I think, Bhavesh, should we take a
Yes.
break here?
So I think what we can do, I think we are at 6:43. Maybe let us take a break now for a 5 minutes, and at or 6:43, let's assemble at 6:50 back, and then we will start with key controversies. So far, we have discussed all the conceptual and practical difficulties around the compliances, and now we are going to discuss the hardcore issues which are generally been faced. So hope that's fine, and I think let's come back at 6:50. Yeah,
Thank
Roopesh?
Thank you.
Yeah.
Yes, sure.
Thank you, sir. Now, break. Selva, it is break time now.
Break for, in the meanwhile, you can enter,
Maybe
update
next
our
poll.
upcoming programs.
Shall we announce now or after coming back?
You can announce now, sir. Just then, once your announcement is finished, I'll just flash a screen.
Then 1 second, we will open up all the programs for the month. Members, for your information, tomorrow, that is on 13th, we have from 6 to 8 CSR, company law and recent developments by CS Bhavesh, New Delhi. And please download the Instagram app, and you will be able to get the information on all the other programs also of SIRC. And coming to other programs of SIRC, yes, 14th from 5 to 8, 14th of May, that is day after tomorrow, that is Friday. Issues in taxation of taxable charitable trusts, including FCRA compliances, by two stalwarts of SIRC region, that is CAE Palgun Kumar from Tirupati and CAM Kardasamy from Chennai on 14th. 15th, overview of valuation from 6 to 8, that is Saturday, CA Parag Ved from Mumbai. Members, this is up to 15th, and next week 18th, 19, 20, 21, 22, up to 22, continuously there are programs, and very importantly, there is a refresher course on information technology from 19th to 21, that is 3 days. Sorry, 19th and 20th, 2 days. 2 days refresher course on information technology. Adarsh Ashok Madrecha from Mumbai, Narasimhan from Chennai, Narasimhan Elangovan from Chennai, Anand Prakash Jengit from Bengaluru. These 4 faculties will be delivering their speeches, and on 18th, Tuesday, how to handle departmental GST issues. Selva,
Sir,
any problem?
no, sir. It seems your webcam is turned off. We'll post the break message and we'll We'll start in another 3 minutes.
Can we post that
Flash
monthly sheet itself directly?
Yes, I'll post it in to all the audience. No problem. I'll just flash my screen. We'll start by 6:50.
Huh?
I will post it in chat box, sir. Right now, we'll break for another 3 minutes. We'll start by 6:50.
Okay, only 2 more minutes time.
Yeah, 2 more minutes. Let them be organized.
Members, I would request you to download the Instagram app, wherein SIRC programs are.
Telegram app.
Telegram, no? Sorry, Telegram app, wherein the programs of the SIRC are announced. I have that downloaded. Yes, Telegram. I have downloaded only yesterday. SIRC updates is the group name. And you can join there. Forthcoming virtual CPE programs of May also are downloaded from 12th itself up to month end. All the programs are downloaded there. Please make use of it. SIRC updates is the name of the group. Okay, already today 177 have joined. Oh, just amazing. 2,292 members have joined this group. 2,292. Thank you all for that. So easy platform to reach the members.
I will start our sessions almost 6:50. I'll give you the present rights.
Welcome back, sir.
Bhavesh, sir, you can unmute yourself.
Is my screen visible?
So you stopped it. You need again to reshare it. Start sharing again. The third button below. Yeah, now it's visible. You can continue.
Yes, sir.
Great. Yeah, so welcome back, friends. Now we're going to discuss I think so far whatever we have discussed about the reporting and documentation, now we're going to discuss some practical challenges and issues which are generally been faced by the Indian taxpayers who could either be a subsidiary of the MNC group, or it could be an Indian parent who themselves have a subsidiary outside. One of the typical key issues which are generally being seen is base erosion, management fee, royalty payment, which is typically you'll see most of the cases of inbound MNC. This is the transaction. Again, marketing intangibles. There is we just cover that in greater detail. Corporate guarantee, the margins for the BPO, KPO, and these are the typically, I would say, 60-70% of the controversy of the Indian transfer pricing regulation surrounds around these key issues. What is the AMP issue? Now, AMP issue typically is when suppose you are a distributor in India and you incur excessive advertisement, market promotion expenditure in order to promote the brand, then typically the tax authorities take a view that suppose if typical distributor would have spent 5% of turnover as a advertisement expense, and here is a taxpayer who spent 20%, then he says that up to 5% normal distributor would have spent, you are spending 20%, so 15%, which is a difference between the 5 and 20. If you are doing a brand building services for foreign parents, and therefore I will want you to recover that from the foreign parent along with the markup. Now, typically, the companies at a various stage of business have a different level of the advertisement marketing spends. I think that may not be the right way to look at merely to look at the advertisement spend, but also look at what the characterization of the entity. If the entity is an entrepreneur entity, then today if it's going to incur the high AMP marketing expenditure, tomorrow it will earn a high profit also. So the judiciary, the tribunals have taken a differing view, rejecting what revenue authorities has taken an approach, and there are three judgments which are landmark in this case: Maruti Suzuki, Sony, and LG. Now, wherein the first of all, the courts have held you should not look at pure expense item and compare with the comparable companies. You should look at a holistic scenario and pricing policy. It may so very well happen that the for Indian entity is getting the product at a lesser price, and due to which it has a higher gross margin, which it is spending on doing local marketing. So therefore, one should not look at a pure comparison of the expense line item. You have to look at an intercompany agreement, and unless and until the foreign company obligates Indian entity to incur certain expenditure, it should not be construed as this is a AMP marketing intangible Indian entity is developing, and therefore it should get compensated. So this is typically you will find in a manufacturing or distribution companies which are having a very high marketing spends. So today, if either in your company or on a client, if you see a very significantly high marketing spend, then department is going to take up this issue. The issue is right now pending with the Supreme Court. It has gone unfortunately into the legal battle, whether unless there is an intercompany agreement, whether AMP, whether marketing intangible should be considered or no. There's enough and more literature on the OECD how one should go and find out, or how one should judge whether the marketing intangible is there or not there. But typically, I think what this requires is a careful drafting of the agreement and the conduct of the taxpayer. If today you demonstrate that there is enough and more flexibility that the local taxpayer has to decide what marketing spend it wants to do, how it has got benefited through subsequent increase in sale or a profit margin, there are good case to defend against this issue. Moving on, second issue, a very interesting one, a very relevant one is a royalty, and something which is very favorite of a taxpayer. Generally, whether it's a royalty for a know-how, royalty for a brand, royalty for a trademark. Often, if the situation is that the if there is a losses or a low margin, royalties are being questioned and they're not been permitted, they're not been allowed. It used to so happen the department also, besides asking for a benchmarking of a royalty, also insist upon show the what the development of a technology have you got. There are companies who are established into business operations into India for let's say 30-40 years, and they have got original technology from the parent, and parent does continuously incur the expenditure on the furtherment of the technology or the manufacturing process. But there has been a huge disallowances with tax authorities at lower level too. However, at a higher level, there is a respite, provided you maintain a good documentation to demonstrate how on a regular basis there is a improvement in technology has been done, people visiting from overseas, what kind of upgrades that you have got, and if you have a sufficient good documentation around it, then it's a good difference can be built around it. However, generally the royalty rate should be set considering the industry benchmark and the overall profitability of the Indian taxpayer, rather than going with a standard rate. We have also seen a situation where typically the royalty the parent want to charge, but initial few years they expect the Indian entity to incur losses or not to have sufficient profit. Then instead of starting a royalty in a 4th year, 5th year, which can become litigated, it will be a good idea that the royalty agreement can be put in place for first 3 years or since the inception, and with some moratorium or waiver that can be granted, so that the intention of the parties can always be demonstrated, and then can be good defense. Otherwise, generally, when the entity turns profitable and you start charging royalty, the tax office typically turns back and disallows the royalty, saying that since historically you're not paid, I will not going to allow it. So this is a vexed issue. I'm sure I think most of us, either I think people in industry practice more would have dealt with it. So that documentation of demonstrating the benefit is a key, and benefit can be in terms of the increased sales, profit, reduction of the cost, competitive advantage, new product line. There are multiple ways where royalty and benefit document can be built. It's good to do this on a real-time basis. Generally, I think if it's left to be built during the post-processing proceeding, that's where the real challenge happens. So good to be built around the when as a transaction taking place. Another typical issue is the management service transaction, and India, there is a commentary of a UN manual where India has gone and said that India considers payment of management services as a base eroding because because I think it's very subjective. Often the MNCs find it difficult to document that services. Now I think now we are living in virtual world, so most of the services do get delivered through uh, through online mode, where I think the documentation retrieval or the maintenance becomes the challenge. So the need test, benefit test, cost test, arm's length test is what I think critical aspect one needs to bear in mind. So management service fee, again a very best issue. Huge trust on the documentation, and often the tax office kind of says that the taxpayer has not been able to demonstrate the benefit. Now, being a part of the large MNC group, you have to have certain proprietary services for which the comparable pricing will not be available. However, I think important thing while you're doing a documentation around a management fee is the agreement should be worded very well. What the parent is going to do, that should be mentioned clearly. Don't or not to overcommit and under deliver. So I think make things clearly. I think define the key parameters in the agreement. How there is be the parameter, like there from 4 meetings, 5 meetings, something of that sort can be more tangibly. Things can get can be put up. If there are monthly meetings happen, then minutes should be mentioned of the meeting, and then the service fee, what markup the overseas entity is rendering, charging, that should be benchmarked. Overall, after making the payment of management fees, the Indian entity should earn sufficient net level profit. Whatever management service fee is coming from the parent, that has to be first bifurcated into shareholder fees, and shareholder fees needs to be separately removed. Just excuse me for 1 second. That should be shareholder fees or duplicative service fee should be removed. There were a lot of questions on a chat box on a non-resident. I think typical question: if non-resident filing return of income in India, is it required to file 3CEB? The answer is yes. If you're having an international transaction, then you're supposed to file it. Then whether there is a transaction of share transfer between two group companies, two non-resident related entities of an Indian entity, and is the seller required to file a 3CEB? Yes, seller is required to file a 3CEB. Now, very interestingly, this is a case wherein the foreign entity was not charging Indian entity, or it waived off the charges, and then said because that is going to lead to a base erosion. Why base erosion? Today, suppose if an Indian company is incurring, if Indian company would have made a payment to a foreign entity, it would have claimed a deduction of the expenditure out of a taxable income, which was chargeable at 30% rate. And when a foreign company, when it receives the income from India, it only pays 10% of the as a withholding taxes. So prior to this instrumentarium corporation, there were a couple of ICAI judgments wherein the foreign entities chose not to charge their Indian subsidiaries, and in such cases, the courts accepted that argument on a base erosion. However, in this case of instrumentarium corporation, the Kolkata tribunal interpreted the Indian transfer pricing law very narrowly and said, irrespective of a base erosion argument, if the foreign company was supposed to receive an income and it has not received the income, it has waived off the income, then the notional income should be input in the hand of the foreign company, and the base origin argument should not be given due regard to. Now, this has actually caused lot of uncertainty. In this case, the Finland entity which has provided a interest-free loan to the Indian subsidiary, and it was not charging the interest on that. So the tribunal came to the conclusion, no, Finland entity should have charged the interest. Likewise, whether it's a service fee, whether it's a royalty, whether it's this thing, the instrumentarium corporation, this is a special bench judgment which is leading to a lot of hardship to a foreign entities, because there may be a situation where, because of practical consideration, even the some time ago I mentioned, you may want to give a waiver of a royalty charges, especially in a COVID scenario where the businesses are not doing well, and a lot of foreign companies are evaluating whether to give the for management cross charge as well as for the royalty, they want to give the waiver. However, right now the implication of the instrumentarium corporation is to borne in mind. This is being challenged in a higher court, and I think we'll wait to see the outcome. Overall, I think the hypothesis that base erosion should not be looked up and each taxpayer is independently supposed to pay taxes and do the compliance is quite a burdensome. Now, another interesting thing, historically, what we have seen, generally non-resident used to file a 3CB in India for the taxable transaction or for the international. Now, typically they used to not conduct a separate deep study, and they used to rely upon the transfer pricing study report of the Indian tax. Now, this was also a situation over here. However, in this case, the AO levied the penalty in a case of the non-resident entity, stating that as per law, you were supposed to maintain the separate transfer pricing documentation and not just place reliance on an Indian taxpayer's document. The taxpayer appealed and the matter went in tribunal. Unfortunately, the tribunal today has given it in favor of the revenue authorities to state that, yeah, the Indian entities, the foreign company should have maintained its own documentation and should not have merely placed reliance upon the documentation of the Indian taxpayer. Now, this we need to understand a little differently. Suppose if I was suppose if I was charging the management cross charge, or I was charging the service fee to India for IT related service, where I'm charging over, cost plus 5% is what suppose the overseas entity is charging to Indian. Typically, what Indian entity does, it receives such charges or does a transaction with a 10 associated enterprise. So it performs a common benchmarking analysis where it aggregates all the transactions and it tests its overall margin. However, and never I think it does a analysis party by party. Otherwise, that will become very uneconomical and also complex for Indian tax. So that's a general practice that you follow the overall TNMM approach and you aggregate all the transactions. Now, suppose if I was availing the services from 5 group companies, and if you expect the 5 group companies to maintain their separate documentation for the services that they have rendered to India, it's extremely difficult. In typically such situation, what one way out one can look at is, suppose if you have entities from a European region, one is rendering the marketing service, one is rendering the technical service, one is rendering financial services. You then, for the services transaction, which is like, maybe a sole transaction from the side of the related party or the overseas entity, but from Indian entity, it is a very minuscule in its overall transaction. Then in such situation, for such foreign companies, the separate benchmarking can be done, taking European entities as trusted party and benchmarking the margin with their charge on to the cost. So that can be one way to kind of protect the foreign companies. But increasingly, if and when you're certifying any 3CBs of a foreign company, one has to exercise now even more extra care for, first of all, ensuring that the reporting of all the transactions is done properly, and second is the benchmarking documentation is also maintained to safeguard itself from the penalty. I think we will have a little bit more discussion around it. I think there are some questions also. So while addressing those questions, this will get covered. Another area of controversy is research and development. Now, what happens is there are Indian captive entities which are typically in a role of conducting the research and development, either in the nature of software engineering, so on and so forth. The Indian revenue expects if you are doing a ideation, if you are doing a innovation, if you are doing a research and development, then one should follow the profit split method for benchmarking, and one should not just go with the TNM cost plus approach. They also came out with the circulars. However, because it was so vague and it was so difficult to comply, circulars were withdrawn. However, when you're doing a R&D, I think it's very important to kind of document that whatever the Indian captive R&D entities are doing, it rarely happens where end-to-end R&D happens in India. It is generally a situation where there is some base R&D has happened and you are just doing an improvement of those products. So I think it's very critical to document what is being done overseas, what is being done in India, how the instructions are getting passed, who is reviewing. So today you may have a captive unit where 500 people are working, but it is not that you need to have a 50 people overseas to monitor the work of 500 people. It may be a group of 10 people also who are entrepreneurs and who have a capability to monitor the work. But most importantly, it should not happen that the captive R&D unit reports into somebody in company in Dubai or a Mauritius where there are hardly any people. So I think having a competent people overseas, how they are giving the instructions to the entity is very critical. And to safeguard, so whenever there is an element of research and development which has been done by the Indian entity, extra care, extra thoughtfulness is required while doing a documentation. And the overall, if you look at even the BEPS guidance also around the R&D, I think the profit should belong to the value creation. And if there is a R&D happening, but I think what component of what percent, what in a valuation analysis, what is the level of R&D which is happening in India is very critical. Other than with the make it term to look at R&D, one has to look at what's an overall context of the R&D and then do this thing. The India has prescribed the safe harbor margin. Again, the condition first of all to become eligible to safe harbor margin is also very stringent. But if you see the markups are pretty high, 30% for IT and for a pharma R&D 29%. So these are very high margin, and that is one of the reasons why not many companies are going with safe harbor margin and themselves are relying upon the documentation. But it's very critical. The TP study report captures the exact PAR, the intercompany agreements, outline the parameters, and that's how the R&D is being taken. This is one of the most, I think, the controversy around Indian transfer regulation is what should be the markup for the BPO versus KPO, and how does one segregate the entity from the BPO to KPO. Today, you see everyone is expected to do more with less. Every company wants to upgrade its skill sets, and therefore, from the pure transaction processing, everyone wants to go to a analytical processing or to value-added processing. Data has to make sense. So there is element of the analysis, element of the analytics which is being taking over. Now, typically the department wants to impute a very high margin on a BPO versus KPO. So instead of generally suppose the captive entity which does some element of analytics and most of the element of transaction processing, instead of covering everything as uniform and not showing analytics separately, it may be better idea to kind of do a proper dissection of the part and segregate the elements of the analytics separately. It may not be worth for a small element of the analytics to expose the entire services they render by Indian captive into a risk. And it may be, while it may cause a little bit of a pain to segregate the services and do a separate markup or a separate segment of profit and loss account, but it will work. The pain will be worth that the activities of a BPO or KPO are segregated, and instead of everything being characterized as a BPO activity where tax office nowadays they come with a very standard questions, and again these questions are being, there's a lot of internet derivation they do and the questions have been drafted. So often it becomes very challenging to refund if there's an element of analytics. Another controversy is on the markup. When you make a documentation, there was a question again chat box. How does one look at a contemporaneous documentation requirement? because by the time you close your financial statement, the document, the financials of the comparables are not available. Yeah, which is why the law provides you the 3-year documentation, and therefore you to look at a 3-year margin. It's important that your transparency audit report contains a very robust economic analysis containing the how you've gone with the search and your backup of the search, because this can be used to defend yourself against in a later stage. Department often arbitrarily eliminates certain low margin companies and they come with their own standard search. Now I think they also become wiser that they give you entire search string, but still there are a lot of flaws into the way they conduct a search because their objective is entirely driven to select a high margin company. So then there can be a, but for in order to first point out for flaws at the search conducted by tax department is very important. When taxpayer conducts a search, also the balance parameters are being taken. Guarantee and interest-free loans, again, very typical area of disputes. Typically, I think when you have Indian parent entities who are giving guarantee, who are giving an interest-free loan, they took a view with the shareholder function, so there should be no compensation. However, the principle of commercial expediency, which is there in domestic law, does not apply in an international context, and therefore if you're doing a cross-border dealing and if you're giving an interest-free loan or a guarantee to overseas subsidiary, the taxpayer should be charging a compensation for that. The benchmarking of the interest and the guarantee fee generally is been done taking the bank quotations from the bank or third party. OECD has prescribed that the quotations are not a right price point to determine. Instead, one should do a proper analysis of what's the credit rating of the subsidiary, the parameters or the conditions in a borrowing country and in the lending country. Considering both the perspectives, the benchmarking will happen. So, in short point, the rate of interest or the guarantee fee should be determined basis the benchmarking analysis rather than merely looking at the bank quotation. For a corporate guarantee, there are many judgments which are there, which says that 0.5% of a corporate guarantee should be good enough for an Indian parent. However, I think the right way to do a pricing is basis the benchmark analysis instead of going with the ad hoc percentage or with a bank. What are the areas of dispute? The low margin and losses of a taxpayer, it's bound to happen in a startup year. There are going to be losses, there are going to be low margin. What does one do? Many times there are two approaches. One approach is to take the loss years, initial years, and you try to make adjustment for startup inefficiencies or try to make adjustment for lesser volume, and you test the Indian entity's margin only. That may be a little riskier because it becomes very easy for any revenue authority to ignore those kind of adjustments. For example, let's take a scenario. There is a company which is into the distribution of the goods. In the first 2 years, it is making 2% margin because of the high rental expense, high employee expense, and all of this. So the Indian taxpayer has a choice whether he makes an adjustment for unutilized capacity, takes the 2% margin of net level to let's take a 4.5, 5%, and then does a benchmarking with a comparable. A risk in that approach is typically the department will deny those kind of adjustments, and therefore you will compare the 2% margin which you earn with the 8-10% margin of the comparable. The department may come back. Another approach is instead of doing the benchmarking between the startup years or with the loss years of benchmarking test Indian entity, one can also look at a benchmarking the margins of the foreign entity, provided foreign entity is a simpler entity. And suppose if there are often a situation where the goods are supplied by the entity which is purely into manufacturing or with a contract manufacturing entity of the group and all. So you rather benchmark the foreign entity's margin, and in a case of a loss or a low margin cases, you also, besides looking at benchmarking Indian tested party, also look at what's the margin which has been earned by the foreign entity. We already touched upon that the foreign entity can be taken as tested party, and now there is adjustments on account of idle capacity, treatment, foreign exchange, custom duty, and all. The challenge with this is data. How do you compute? Earlier on, when there was
XBLR format was not prescribed. The companies in a note to account used to give the quantity details, production details, capacity details. It was easy to compute the details. But now in this situation, it becomes extremely difficult to compute the ideal capacity. Still, what one can do is, often there are industry reports available which does say that in industry what level of capacity the general industry is working upon it, and this is the industry report or a specific data points it can be gathered from some industry reliable sources. The adjustments can be done, but often the adjustments are related to high litigation. We are living in a COVID world, and the impact of COVID is felt by every one of us. So do limited risk entities also. Now, often limited risk entity prior to COVID, it was understood irrespective of what happened, the foreign principal will take the risk, and the Indian entity will get a assured uptake of the margins on the sales or the cost which it incurs. Now, COVID has in fact challenged that assumption significantly, and there are situations where the foreign group companies do want to apportion the losses which they are incurring also to a limited risk distribution entities, because the argument they are taking limited risk does not mean no risk. So there is some element of risk, and if there is a overall there's a loss which the group has incurred into the system, then that some portion of the risk has to loss has to come in. Now, counter to that argument is, suppose if there was a significant profit that the foreign entity would have made, would it have given a excess profit to the Indian entity? The answer to that appears to be no. So therefore, I think it's very critical to again look at how the intercompany contracts have been worded. If there are, the group has to very consciously, if in a COVID year it want to apportion the losses, then what kind of risk it wants to give it to the Indian entity, and that has to be documented in the intercompany policies and everything. And care should be taken that if you want to, the risk which is legitimately can be apportioned only to a distribution function which has been done, can be apportioned instead of, if there is a risk which is relatable to the R&D or to the overall financial risk which has been losses that have been incurred overseas, that should not be allocated to the Indian. Again, it's not one size fits all. I think this is subject is so vast itself will require a minimum an hour's discussion. But critical point to note is before one goes to do any such adjustment, to look at what is the intercompany agreement, what has been a historical dealing, how in a customs you have justified your transfer pricing, what have you done a documentation in the past, what arguments you have made. After taking into consideration all of this, only one needs to look at whether Indian entity which is historically been getting compensated on a risk or compensated on a fixed margin basis. Is it really is it really worth, I think, disturb that pricing policy and to amend the pricing policy, and therefore either reduce that margin or to kind of apportion the portion of loss which has been incurred overseas. We'll go on to the BEPS compliances. Now, typically this is again applicable to large companies, not to a small company. It has three elements: country by country.
Sorry, sir, voice is getting break in between. So while you're moving away from the screen, it's getting fast and it's delivered. So if you don't move, it will be.
Okay.
I can try. Yes, please.
Can I go on?
Sir, yes, please.
Yeah, thanks. So there are three kinds of requirement, which are country by country report, master file, local file. Local file is local TP, the transfer study report, which Roopesh covered earlier. Master file again applies to the companies which are having transactions of more than 50 crores or the intangible payment of more than 10 crores. Then detailed master file has to get filed, and the country by country report applies to the MNC group, which has more than 7,600 crore of the total turnover, which is equivalent to 750 million euro. So, country by country report, if you are subsidiary of overseas companies, then you are supposed to only file notifications, and then the country by country report need to be filed only in one country by the parent wherever it is resident of that. Master file is something which is while OECD originally envisaged that has to be filed in a home country, But however, I think the various countries did not agree, and master file typically will also will require to be filed for Indian inbound entity in India for but if provided it is crossing the turnover of transaction value of cross-border transaction more than 50 crore and intangible payment of more than 10 crore. In absence of that kind of threshold value, it has to only intimate very basic information in a party. I think there was also a question in the chat box where can you show that how this form needs to be filled in. I'm afraid I think this is a very detailed exercise, so if you do not, but however we'll cover a little bit of what are the nuances. So this is the applicability of master file. There are twin conditions that aggregate value of insurance plans should be more than 50 crore or intent payment of more than 10 crore, and the consolidated revenue of the group is more than 500 crore. In such situation, for every year, for every taxpayer, they have to file this master file by the time they file a return of income in India. It has three parts: Part A, Part B, and intimation. Intimation is typically that which end group it belongs to. Part A, irrespective of whether you're crossing that threshold or no, you have to file. And Part B is only once you meet the threshold, then you have to file. And this is it's a very onerous and detailed requirement. What are the requirements? It is listed down over here. That top 5 product of the group. What is the for the entities in a group which are having more than contributing to the group for more than 10% asset, profit, or turnover, that has to get reported. And the master file is lot qualitative information about the group. Typically, OECD has prescribed this that master file in country by country should be only used for doing a smell test by the Indian revenue authorities or by revenue authorities of all the country to see whether which entity should be selected for a scrutiny on. OECD has prescribed the standard requirement. However, India has prescribed the 3 additional requirements over and above what OECD has prescribed, which are mentioned in this slide. And basis that this documentations are being used in order to do a risk assessment and to select whether the entity should be selected for a scrutiny. Again, this is not having applicability in most of factors, so we'll not spend too much time on this. CBCR, it's a numerical representation of the entire group's turnover. Again, this will, if it's an Indian headquartered group which is crossing the threshold of 6,400 crore, based on the ration notification of 5,500 crore, then it's required to file this documentation in India. Otherwise, you're generally supposed to file an intimation, and tax authorities are supposed to get this using the automatic exchange information route. And the taxpayers are not supposed to file it in India if the parent entity will file in the respective country. This is how the country by country report will look like, where you will have the number of total revenue, profit, law, income, number of employees, jurisdiction wise. So master file along with the country by country. This was done because I think it was felt that the MNCs are not disclosing their full facts in all tax jurisdictions, and therefore after a lot of deliberation, the consensus documentation was evolved and these templates were made. And right now, this is being made applicable only to a large taxpayers. I think we will skip this in interest of time and to answer other questions. The remaining part, and now coming on to the advanced pricing agreement. Advanced pricing agreement again is a mechanism which has been very, I think, one program which has been introduced in India and has received a lot of success is this APA. In a short, it's called APA, wherein the taxpayer can approach the tax authority and upfront agree the pricing for intercompany transaction for 5 years for future and a 4-year backward. It's a very I think collaborative process, and but the critical point is there's the willingness on part of taxpayer to disclose all the tax very transparently, and once that has been done, experience has been very positive. Tax authorities have been also very forthcoming, and India has already signed 271 advance pricing agreements out of the close to 1155 agreement which has been filed. So it's something very positive, and it's kind of has garnered a lot of attention. But again, it is worth only if you have a very sizable transaction, and also it requires a kind of good amount of time and effort on part of taxpayers also. Typically, a conclusion of the advance purchasing agreement typically takes somewhere between 18 months to 36 months. In some cases, it may go to 48 months also. So therefore, before diving into the advance purchasing agreement, one has to do a proper analysis. And once I think when there is a lot of willingness and support from the parent entity, one can make use of this approach. Safe harbor provisions. Again, we discussed safe harbor. What is safe harbor? Safe harbor is typically a agreed margin, premium margin, which is prescribed for the various category of services, and that whether it's for IT service, KPO service, or a corporate guarantee, this is margin service prescribed. I think with this deck, and then we will have I think one can look at it. Again, as I mentioned, not many companies have taken advantage of this safe harbor because the conditions are very stringent. I think I'll take a pause over here, and now we would like to kind of focus on the questions which have been raised in the Q&A box.
Sir, can we go to Q&A question now?
Yeah, please go to yeah.
Yes. In the meanwhile, can you try headphone or something? Yeah.
Yeah, I'm putting them.
Shall I share the screen now so that
I think we've answered some of the questions on the chat box. Maybe we'll go to the latest set of.
Roopesh?
Yeah. Probably if you can go a little further down, I think some of these questions Bhavesh has answered in the chat box.
So, yes. So, which from which question do you want to?
I think up to probably 20 he's answered. We'll go to question 20. It's still a little faint, Bhavesh. I'll try to. Yeah. So let's start with question 19. Based on the usage of terms, contemporaneous documentation, the transfer pricing study should be completed before. So, see, there are two things here. One is the documentation needs to be maintained before the return filing due date. That is one part of the point. That the entire documentation for a financial year should be completed. If the return filing due date is the 30th November, you maintain the documentation within that period, and on that basis, you issue the transfer pricing certificate as well. But when they say contemporaneous documentation, what it also means is that as and when transactions happen to the extent practically possible, some of the like invoices, you don't wait till the end of the year or after the end of the year. You maintain documentations as and when they occur. I think that's what broadly contemporaneous documentation means. But as the overall, the entire Rule 10D documentation, you are allowed time till filing your date of return. Right? Next question can be used. Yeah, go ahead.
Can we? I think that we answered, no, Roopesh? Can we use intercompany? We answered that.
Yeah. So
question number 21. With respect to intercompany loan, considering labor rate, which is the most approved method, CUP or other method, and does it make any difference if it's in Indian currency? So look, if the loan is in Indian currency, then the labor should not be taken as a base. The labor should, I think the rate of the benchmarking would depend upon the currency in which the loan is being taken. And if it's a labor, then labor is again a rate derived based the average of the multiple rates. So better to use a method as the other method and not method as a cup.
Yeah, just to add, if it's see, if it is a in foreign currency, if you look at the ECB guidelines also, external commercial borrowings, there are limits prescribed by RBI for loans taken in foreign currency, right? So typically you use this LIBOR rate for foreign currency loans because the LIBOR is derived based on London interbank rate, which is for not Indian currency, but for US or Euro, etc. While for Indian currency loans, you typically use a Indian benchmark, like what typically a bank PLR rate, etc., which can be considered as a benchmark. That is like a maximum cap, but ideally you should try to do a specific comparable search based on whatever interest rate information that is available. Right? That's I hope that answers that question. Question 22, during a TPS assessment, AO has identified comparable companies as on date for assessing the case, which is 6 to 7 years old. How far is it? I think no, so the comparable data, again, one of the points on whether it should be contemporaneous documentation, can you use same documentation for multiple years? I think you need to consider the fact that you are allowed to use comparable data only up to a period of 3 years prior to, from the year in which you are actually having the transaction. So there is a concept of multiple year data which is allowed to be used for comparable companies. You cannot use comparable data which is for 6 to 7 years old. You can go only up to a period of 2 years prior to the year in which you are having the transaction. So for example, if it is financial year 1920, you take data of financial year 1920, 1819, 1718. That's as far as you.
Okay.
You want to take the next
Question
one?
number 23. Yeah, question number 23. Can we use cost plus method for services provided in ITS if the cost incurred for a project executed for overseas A are clearly ascertained? Would a cost plus 17% would be accepted? So the challenge with the cost plus method requires a comparison of a gross profit on the cost. Typically in the Indian databases, since we don't get a gross profit data, therefore even for a services transaction, what we do is we try and do a transaction at margin method. And in such situation, if there is a like if you look at the Indian safe harbor rules for the transaction processing kind of nature, which is a kind of a very low end activity, 17% markup has been prescribed. Typically, if it's a complex activity which requires technical skills and all, the appropriate benchmarking should be done. But any markup which is in kind of in line with comparable companies, without knowing the nature, it may not be right to comment on the markup percentage. But typically, what we have seen is technical services which are there. Generally the markup of a technical services ranges somewhere between 18% to 25% and upward, depending upon the nature of service. Yeah,
so
you can take a
next question. If there is no change in the terms and conditions in the agreement as well as pricing, is it mandatory to prepare and maintain documentation? I think, yeah, if there is no change in the absolutely no change in the business, then you can roll over whatever documentation you already have. The only limitation, as I told earlier, is that your comparable data for the past 2 years plus the current year can be used. So you may just need to update your benchmarking analysis. Other than that, if there is no change in the facts, the agreement, and it's a fairly simple transaction, you can roll over whatever you prepared in the past years to the following year. It is better at least once in 3 years to test whether there is any significant change in facts and redo the documentation. Otherwise, you can update it on a year-on-year basis.
Okay. Question number 25. In a multiple year concept, details of past two assessment years of the comparable is taken. Can the tested party, that is assessee, also take a can also take its past 2 year assessment years or only current year of the assessment to be taken? So right now, I think the law only permits a comparison margin of the current year of tested party, that's assessee, with the 3-year data of the comparable company. A lot of representation is being made to the government to say that because of this pandemic, the margins of the tested party has got impacted or the assessee has got impacted. So also permits the usage of 3 years for the taxpayer. However, until any clarification comes, that will not be possible. And as per the rules as it stands today, the only current year margin of the taxpayer needs to be compared with the 3-year margin of the comparable. Yeah.
Right. The other, I mean, it's an interesting question. In cup method, can either party be taken as a tested party? It really depends on the context. Typically, you would test the Indian entity's pricing with an identical comparable situation, or cup is basically comparing the price and not margins, right? So the concept of tested party doesn't typically apply. You apply it on the Indian side, but depending on the context and situation, we need to see this. Basically, since you are applying it on the price, the tested party really doesn't apply.
Correct. So tested party concept does not apply in a cup. The cup can be either an internal cup or an external. Internal cup can be also from whether the taxpayer has purchased similar product from third party or the group company has purchased from the third. Okay. Question number 27. From your experience, can no expenditure be deducted from the safe harbor prescribed margin? Example, safe harbor margin be 18%. Should the net profit margin be flat 18 in such way that no other expenditure is deducted from it? Yeah, no other expenditure should be deducted from it. Safe harbor, in order to be eligible, you have to either achieve that much margin or a margin above that prescribed margin. There should be no deduction allowed. This is the minimum base margin which are prescribed in order to be taxpayer wants to opt for a safe harbor. There will be a situation where in the books you may not have the 18% margin, you may have 15% margin. In such situation, you will have to move a sumo to adjustment and bring your margin up to 18% margin. But if you want to avail a safe harbor, you have to declare minimum margin of whatever is prescribed in safe harbor.
Right.
Yeah,
at 28, I think Bhavesh has replied. If you have manufacturing more than 1 crore and services more or less than 1 crore, yes, you would have to benchmark for both transactions. Question 29, yeah. Sole proprietor individual is exporting software services to US company and is a director. Would it be, I think as per section 92A, this will get covered and it will be an associate enterprise for which you have to. So you just need to see whether you satisfy 92A1 and A2.
Yeah, so it merely just because you have one common director both the entities, it may not. I think there are conditions prescribed over there. So I think that condition needs to be looked at.
You want to take the next one?
Yeah, is it compulsory to follow single method for computation of all transactions which are of different nature? No, it is not compulsory to take a single method. In fact, there is a very well possible that for royalty you may take a cup method, and for the imports you may take another method. For interest you may take other method. So the method has. So in fact, the Indian law requires the benchmarking transaction by transaction, and each transaction depending upon a fact and data availability method can be where different method can be used. Yeah,
only the infusion of share capital is the only transaction whether it is required. Technically, yes, you would, because that is also issuing the share capital and getting the money is a intercompany transaction, international transaction. So you just need to report it, but there is no consequence on income. It's more a reporting requirement.
But what happens is, suppose tomorrow you're going to dispose of this Indian entity shares, and there's a capital gain which is going to get taxable. You're going to claim reduction of this cost of acquisition.
and therefore, while there may not be an implication of income in the year when the shares are subscribed, it is good to do reporting, and there has been a specific requirement for issue of shares under clause 16 of 3 CEB. So, when there is an infusion of a share capital, both the entity whom the shares who has issued the shares and the subscriber share, both has to file a fee.
Whether non-interest bearing loan taken from foreign holding company needs to be reported. Yes, even if it is non-interest bearing loan, it is still an international transaction. So there is no income expense as per the books, but you need to test whether in an arm's length situation, should there be an interest, right? So that's the whole purpose of transfer pricing, that artificially you may not pay or you may not receive an interest. In this case, if you have taken a loan from your foreign holding company and you pay zero interest, you may show that there was zero interest that was paid.
Yeah, so again, what we need to report is again the transaction and whether also the loan amount. There's also a question comes whether loan amount also needs to get reported. So under clause 14 of 3CB, if you see the disclosure requirement, there is no disclosure requirement laid down for reporting the loan amount also. And typically the loan amount itself is very large. So it's only in a year of repayment or a year of you borrow that the question arises. I think depending upon, we have seen a situation where department actually has applied a penalty for certain taxpayers for not reporting the loan amount, but typically it is not required to. However, it may be a good, I think, either minimum by way of a note, you disclose the loan amount, and whatever the inconsequential interest is there, that you disclose as the main transaction.
Right.
We move on.
Yeah, under clause 10, in case of deemed international transaction. So that's an interesting question. Deemed international transaction is not really a transaction with an associate enterprise. So you don't disclose it under clause 10. You disclose it under clause 20, as I earlier explained in the slides. Directly under clause 20, you just report it as a transaction. It is not with an associate enterprise. So it doesn't get reported under clause 10. Bhavesh, are there? So 34.
Yeah.
Whether
but the company has to report external commercial borrowing taken from A, please confirm. Yeah, again, I think I addressed this point. The consequential interest certainly needs reporting. Whether the ECB amount there minimum, I think there are one of the two choice. One is to report this loan amount under the clause 19, or you report the loan amount by way of a loan. I think if it's only I think if you want to safeguard yourself on a penalty, I think the better view would be that you report the loan amount by way of a note and consequential interest on the ECB into the clause 14.
In 35, you already answered just the earlier question, sir, duplication.
Yeah.
36, again, I think it's a very specific issue on advice to specific facts of the case. I think that will take too much time. If I go to 37, for resale price method, I think the basis of identifying comparable companies is quite similar in terms of how you do a benchmarking analysis. Just that in a resale price method, as I said, it's typically used in the case of trading distribution companies. And so if you take comparable distribution companies, the only thing is we call it as a profit level indicator, which means what ratio do you use? Do you use a net margin or a gross margin? In the case of a resale price method, you use a gross margin. You compare your gross margin of the distributor against other distributors who are comparable to you. So that's the concept.
Can you illustrate serving 15 A's and billing one of them? Is it not obligatory to bill the entity to whom services was rendered? So typically in situation there are a lot of situations which happens where MNC group have only one entity, central entity, who does the billing and coordination. So as far as India is concerned,
you may render services to 15 group companies, but if you have a current arrangement with a parent entity which is settling on behalf of all the substantive, this is quite legitimate, and there is no need to bill each and every respective entity. Even in a secondary adjustment provision, where suppose you have rendered service to 10 entities, and you are now required to get the money on account of addition suffered by you. So in such situation also, even if you get it from the one entity, it's permissible. So single billing one entity is quite possible. Yeah, Roopesh.
Yeah. Next one is deemed international transaction. Which party name we need to mention as related party? So if you look at the form, it specifically asks in clause 20 what is the name of the other party. So you need to disclose the third party's name with whom you are actually doing the transaction, not your related party, because the question in the form itself, the name of the person other than the associated enterprise with whom the deemed international transaction is entered. So you disclose the third party.
And maybe in a bracket, if you want, you can write the name of the AE. Because in clause 10, what happens, you written the name of the AE, but clause 10 only requires you to write the name of the AE. So maybe I think for a better reconciliation, I think at least in a bracket, if you write the name of third party, in bracket you write the name of the AE. Clause 4, question number 4. Yeah. As per section 92 rule 10D, companies are required to maintain documentation only if aggregate value is exceeding 1 crore. In case turnover is less than 1 crore, as an auditor, can we mention documentation not required to maintain in 3CB report? Yes, we can mention so. And even when we sign any 3CB which is transaction with less than 1 crore, we do mention that the taxpayer is not obligated as per rule 10D to maintain documentation. However, while there may not be need to maintain a formal documentation as per rule 10D, however, the taxpayer still is required to mention the documentation to justify how it has arrived at the arm's length price. So, while all the requirement of rule 10 need not be satisfied by taxpayer, but in case of any scrutiny or subsequent year, any reopening under 147, anything of that sort, the taxpayer should have a documentation justify how it has arrived at arm's length price for this transaction.
41. In what cases a foreign company is mandated to file income tax? So for filing an income tax return, I think clearly the provisions under 115A is provided. So there are certain exemptions. So if there basically is there a taxable income earned by the non-resident or a foreign company in India, there are certain exemptions given, like if they receive dividend or
interest and dividend. And second is now if their withholding in their cases happened as per the rate applicable to domestic tax law, then I think they are obligated, they are not required to file return.
There is an exemption in filing tax returns in certain situations. If TDS withholding has happened on royalty fees for technical services as per the domestic rates. But an interesting question is, should they still file a Form 3CB in the absence of filing a return? There is no such exemption given. So in our view, on the safer side, it is better to still file a Form 3CB because there is no similar exemption given. If you have taxable income, it's the foreign company still needs to file a Form 3CB in India. That's the answer to the question.
And also be mindful of the fact that the non-filing penalty for 3CB, while not filing 3CB is 1 lakh rupees, and non-reporting of transaction is 2% of value of transaction. So in view of no exemption available to the for 3CB, I think one has to be very careful in taking a position. And if the foreign company is earning taxable income in India, then from a related party, then the 3CB should get filed. For 42, basis of computing gross and net margin in case of a services, can we take only net margin for a cost plus method and TNM? How to identify comparable company in case royalty kind of transactions where consideration is not based on market but typically based on this. So basis of computing net and gross margin, I think we cannot compute a gross margin, but I think we can only look at net margin because for service company, anyway, data, how do you compute a gross margin is very difficult. And in case of a royalty, look,
there is a royalty stat database on there that agreements are available. So in that cases, the question is, how to identify comparable company in case of royalty kind of transaction where the considering not is the market, but typically they, yeah. So for royalty kind of transaction, there is a royalty stat kind of database which are available, which prescribes the various agreements. One can look at the agreement and the rates can get prescribed. So it is possible. Broadly similar nature of products royalty one can do. The specific search can be done in database to arrive at this kind of royalty rates.
Since there are
Uh,
multiple
good.
questions, I'll probably just
Yeah.
skip a few. If you can go further down,
Yeah.
45 looks a little interesting. 45.
Yeah.
In case of startup companies, most of companies will be posting losses. The company imports raw material, use the raw material along with local raw material, since there will be indirect costs. It's difficult to apply TNMM. So it's a fair point that especially new companies, starting up, and especially if they're selling in the local market. So this is where the FAR analysis I mentioned becomes important, that you need to show what is the functions and risk perform, what is the industry in which it performs, what is the competitive scenario there. The Indian entity is taking the full market risk in selling in the local market, and they're a new startup company, then obviously they, as you mentioned, they could be incurring losses. But to document the reason for those losses during the year, what is the impact of the intercompany transaction that has contributed to the losses? You need to strategize as to what other, so as you said, TNMM, there could be some challenges. If you still want to use TNMM as the most appropriate method, you may need to make some adjustments. We call it economic adjustments, to be able to compare it with comparables. Otherwise, you may argue that it is not comparable, or you try to use other methods that are allowed under the law. It really depends on the context of the situation, but typically these are the issues we will face, right? If there is a new company, it cannot become profitable from year one. That's fairly understandable. The purpose of the documentation is to see how you bring the economic context and justify those losses. Right?
Question number 46 has to be covered. Even if the non-resident seller is making a long-term losses, it should comply with the transfer pricing regulation into it. Yeah. So question 47,
47
Roopesh,
we
I think
already
you
answered.
answered.
48,
What
what
about
about
the
free of cost supply reporting?
supply reporting in 3CG? Please explain in detail form
So
3CA and 3.
as I
Yeah,
mentioned, free of cost, even though there is no consideration, it's still a transaction. So you may need to report it. As I said, in clause 19, it can be reported as a residual clause. I think master file 3CEA is the master file, and related and CBC are related forms, which I think Bhavesh had already taken through those slides on what is the requirement there, and the threshold limits which has to be satisfied where you need to file them. We'll move on. 49, under which clause reimbursement of expenses and travel advances to be reported. Again, it may be reported under clause 19 as a residual clause. 20, you want to answer? 50, sorry.
yeah. Is there a threshold percentage prescribed for changing shareholding to determine the business restructuring? No, the business restructuring definition is very wide. It says if there's an impact onto the profit, loss, income, expense in this year or a future year, and there's a detailed paper of OECD. What does a business restructuring mean? In a simplistic term, if there is a change into the functions, risks, cross-border movement of functions and risks, that qualifies for business restructuring. There is no shareholding percentage prescribed. Typically, I think even if there can be a simplistic group reorganization, that could typically fall within the business restructuring. However, the guidance given by OECD is very useful, where there has to be a change in the functions and the risks of the entities to satisfy a business.
There's no threshold percentage as such.
Yeah.
I think again 51, 52 are all repetition.
Yeah.
We are coming close to the time. We'll just choose one or two more questions and then we can wrap it up. How effective is the reliance on OECD guidance? Does the department accept any argument? That's a good question. See, I think there's a lot of judicial precedents that says that where it is directly given under the law, then you have to rely on what is given under our income tax law or rules. But if there is no guidance in our income tax law or rules, then if it is relevant, you can try to place reliance on OECD. India is not an OECD member country as such, so but we have seen a lot of courts rely on OECD guidance where there is absence of guidance in our Indian law. So where does department accept? They may or may not. It is controversial, but I think like for the example of a business restructuring, there's no definition as such, but you try to take guidance from OECD in the absence of any direct literature in our regulations. So you
Yeah,
want to take
question
a
number
couple of more
56.
questions?
Yeah, 56, 20 crore threshold limit of a specified domestic transaction in each wise or aggregate for all AEs. I think this is aggregate for all AEs, not each AE. What about a suo motu disallowance offered in return of income? When period of 90 days will start? So suo motu disallowance, so I think the 90 days period will start from the, suppose 30th November you filed a return of income, then from 1st December, the 90 days period will start.
Right. Is there any reasoning to be given to tax department? So in my example, which I gave for not bringing 5 crores, you don't need to bring in a reasoning. If you, the alternative that if you're not able to repatriate the 5 crores in my example of secondary adjustment, you can pay that 18% plus surcharge or cess as given under the rules. You don't need to give a reason.
So I think 59, will a guarantee given by Indian company or an Indian bank will also get covered in 94B. So I think the guarantee has to be given by the related party for a loan which has been taken. So you may have taken loan from the bank, but that has to be guaranteed by your parent entity. So either parent entity gives you a loan or a third party gives a loan to which the parent entity has given a guarantee. Then 90. So either related party borrowing or a borrowing from third party secured by related party to which the 94B applies.
Right, I'm conscious of time. It's 8 o'clock. I think there are a lot of questions, which shows that there has been a lot of interest and from the participants, which we are very happy to see. But I think in the interest of time, I'll take guidance from the chairman and secretary. Thank you.
Thank you, sir. Thank you. Initially, I thought that whether the 3 hours required for this subject, the people whether will continue to listen for up to the 3 hours of the CP program. But members showed that their interest, the way in which they posted the query, and you handled it very well. Thank you so much, sir. I request Panaraj sir to propose a word of thanks.
Thank you very much, Bhavesh ji and for the excellent presentation and the very number of, as rightly pointed out by our chairman, the number of queries raised definitely shows the interest that the members have and also the clarifications that you are given. And the new being the relatively off the main track for regular professionals, these types of topics require excellent insight into these things, and both of you have extraordinarily done your job. We on behalf of SIRC thank both of you, Bhavesh ji and Roopesh, for your excellent efforts. I also thank the participants for the program. It was almost 270 or so. Now some people have left after questionnaires, but then so many questions have definitely given some what's called happiness to the speakers also. So thank you all the delegates, but for your participation, these programs would not happen. And I also congratulate Chairman for choosing this topic at the risk of what is called taking 3 hours on this topic also. So thank you very much, and also I thank the back office of SIRC and also technicals and Mr. Selva for this. Thank you, one and all.
No, we would
Thank
also
you so
like
much
to
for the
thank the
opportunity.
SIRC team for giving us the opportunity, and I think really great job done. I think the amount of personal interest which I think the SIRC team took in coordinating with us, in ensuring that the content of the program is in line with the expectation, and I think meets the audience expectation. I think really great job done by all of you. Thank you so much, sir. Thank you. Really big round
Thank
of
you. I
applause for
echo the same.
Thank you, sir.
Thank you so
Thank you
much.
so much.
Thank you.
Be safe. Good night. Good night, sir.
Thank you.
Yeah, thank you. Bye.
All safe and healthy. Stay at home.
Yeah.
Thank you.
Thank you, sir.